Today, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate.
Those dissents were not done in a vacuum. Many people on the board are leaning towards a rate hike.
I'm particularly glad with the fact that they've listed the 3 dissenters.
Having dissents is not unusual. That being said, there's very little to hang your hat on in the market.
If the data ends up coming in line with his side, this may all work out, but if not, this could end pretty poorly.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, questioning credibility. An evasive Fed chair testing the bond market's patience. Meta's Mark Zuckerberg struggling to defend massive spending. And the US and Iran failing to stop the conflict from spreading. Oil holding on to the 90s.
It seems like all the pillars that have been holding up this market are getting kicked out from under it. On one hand, you've got higher long-term rates following that Fed meeting. You have worries about CapEx spending and cash flow not keeping pace, actually turning negative for Alphabet and really going down to the lowest level since 2022 for Meta. And then you have oil fueling additional inflation fears, and you put this together, and it's a toxic brew for the morning.
Well, let's talk about a statement from this Federal Reserve. It was in the statement again at the very bottom, the last line. The committee will deliver price stability. This market is beginning to question the willingness to follow through.
This market is calling the Fed's bluff and saying, ultimately, if you're not willing to hike rates, you're not willing to give us a sense of why you're not hiking rates right now, and if you're going to talk around the issue and not give us a clear answer about absolutely anything, we're not going to believe that you actually are going to take action. You're trying to jawbone us, and you think that we're too stupid to fall for it. Guess what? We're going to call your bluff. The bond vigilantes are back out, and that's the reason why the yield curve steepened the most going back to April, before a Fed meeting going back to 2022 when they hiked by 50 basis points.
And he's in a really difficult position. Not only do we have, the first time in 10 years, 3 dissenters, and he has to come out and defend what their decision was, which I'm still confused about actually the communication about why they didn't hike, what his reaction was there to that. But on top of that, just moments after you have this decision, you have this press conference, the president once again says, well, it's not Kevin's fault. It's not his fault. He's fantastic. It's the board. It's political. He's going to be sandwiched now in between both these rival forces.
It's not the first time we've seen a central banker make a communication error. This was a mess of a news conference. We've seen something similar from Lagarde at the ECB in her early years. We saw something from Powell years ago in his first term. We're seeing the same thing again from Kevin Warsh. I think what is difficult about this moment is the backdrop. The backdrop for this communication mess is unforgiving. The amount of supply you're seeing in the Treasury market, the amount of supply that's coming from mega-cap tech, the amount of supply you're seeing internationally, Germany, and elsewhere too. Brower, that makes this moment very, very unforgiving, and they'll have to get a handle on it because the price of capital is going up and things are moving in the wrong direction.
Bond investors have leverage. And when bond investors have leverage, well, you want to be them because guess what? They will exact a pound of flesh, and that is what they're doing this morning. If you're not going to give them a sense that you truly are committed to price stability and keeping inflation expectations anchored, well, guess what? They are going to penalize you. And that is the reason why not only did you see people flee from the U.S. long-term bonds, but also the U.S. dollar, saying we're not sure that this central bank has what it takes to really get through what they're promising right now.
No one needs our opinion today, this morning. Just park all that. Just focus on the market reaction to Bramo's point. The front end rallied, the long end sold off, inflation expectations firmed up, and the dollar weakened. That tells you everything you need to know about a rejection of this Federal Reserve, a rejection of them claiming they'll fight inflation.
And to Annmarie's point, the fact that President Trump came out and said Kevin Warsh is wonderful, he's doing a great job, it's the rest of the committee, didn't do anyone any favors. What it did was it undermined further any kind of credibility that this Fed could have taken hold of had they hiked or had they had a more hawkish proclamation. The more that people see Kevin Warsh and Donald Trump moving in tandem, the more they are going to see this Federal Reserve as fundamentally compromised.
Yeah, the optics of the last 24 hours really not great for this bond market. Equity futures doing better. We're bouncing back by a third of 1% on the S&P. Coming up this hour, we'll catch up with Barbara Reinhard of Voya Investment Management as the bond market pushes back. Norman Roule of CSIS as the US launches a heavy wave of strikes against Iran. And Gregg Moskowitz of Mizuho as Microsoft cloud growth impresses investors. That stock getting it done in the pre-market. We begin this hour with the bond market questioning Fed Chair Kevin Warsh's inflation-fighting credibility, sending 30-year bond yields to the highest level since 2007. Barbara Reinhard of Voya Investment Management joins us now for more. Barbara, good morning.
Good morning.
What was your reaction to that yesterday afternoon?
Look, he's falling into the same trap that so many Fed chair people fall into when they take the role. And it's a communication blunder. It's sending the wrong signals to the market. And this is what we were worried about with a new fair chairperson coming in, is that equity markets are going to get nervous. You saw the same thing with Jerome Powell. There was an 18% correction within the S&P 500 when he said we're a long way from neutral, a very offhanded remark. And I think you do have a credibility issue at this point. So the Fed's going to need to either get inflation under control or the bond market's going to do it for it. And we do see on some of our forward-looking indicators that inflation should be rolling over. Income growth is starting to slow. Consumer spending is starting to slow. But the fact is it may not be fast enough to stop probably more equity market weakness as a result of bond yields climbing.
Lots of reaction coming from Wall Street. One of my favourite takes came from Aditya Bave of Bank of America, duffed and confused. And he said the following: we think the need to re-establish credibility increases the probability of a hike in September. Do you agree?
Well, I think the inflation data is going to come in a lot softer. So all of our forward inflation indicators are rolling over at this point. So the market may indeed do some of the Fed's work for it, which is what Warsh was confusing the markets about yesterday. I think this lack of forward guidance is coming at a particularly bad time. And I think that this kind of pulling back and relying on some of these task forces, while it's a great idea in theory, the execution of it seems a little bit murky at this point, which I think is also confusing the bond market.
Given some of the confusion and concerns around a lack of credibility that the Fed's going to follow through in anchoring inflation expectations, do you think that that puts the tech trade more at risk, considering that it's a higher duration asset increasingly as a result of its CapEx plans?
Well, I think you've got two things going on. So, number one, the tech trade is really as a result of the hyperscalers burning through their cash flow, not slowing down on their CapEx spending. Eventually, the memory shortage is going to get resolved with more memory. So there's this concern that you've got this big cash flow burn with the tech stocks. You're not seeing the big productivity lifts from AI just yet, although we all use it in our day-to-day lives and are finding it to be incredibly helpful. I think that you've got this concern that they're burning through so much cash flow, and additionally, this equity supply that's hitting the market is really big, and the buybacks and the mergers are just beginning to offset it. This is the first time since 2000 in this year that you're going to see net equity issuance and net equity demand kind of coming out of it. So buybacks and also mergers really being even. So it's a lot to hit the tech trade at this point.
About a year ago, I was speaking with Howard Marks, and he said if he were going to get into the tech trade, even though he's typically a credit investor, he'd rather be in the equity than the credit because he's getting paid for the equity in terms of the potential upside.
Sure.
I wonder if that equation has flipped right now, whether potentially you're getting paid to be in the bond side of things and not necessarily on the equity side as a result of the dynamic, as a result of how high yields have gotten.
Well, I think there is some truth to that. However, you have to think about it this way. Credit spreads have just started to weaken really over the past 10 days. You're about 10 basis points wider on IG credit. But I think you have to do a lot of homework as a credit investor in these hyperscalers, off-balance sheet, data center-backed bonds that are being issued. You really need to find out whose balance sheet is being, decked against these interest payments. And that's going to be a really tricky one, even for the most astute of credit investors to look into.
So do you think something people want to stay away from for the remainder of the year?
Well, when we take a look at the internals of the market, look, the S&P 500 just slipped below its 50-day moving average. There's, quite a ways to go until it hits its 200-day. But the American Association of Individual Investors, it's 30% bulls, it's 42% bears. That could mean that you have a little bit of a counter-trend rally. But there's also one thing that we're not talking about that's bugging the market, which is the midterm elections. Markets do not like uncertainty. Generally, those summers before the midterm elections can be very ugly. You don't necessarily need to get all the way to election day, but you probably need to get to maybe mid-October for oil prices to come down, for the inflation data to roll over, to really probably put in a more sustainable bottom.
It's not also just the midterm election. It's also the conflict in the Middle East. The market thought the president was going to take a diplomatic route, and right now we actually see more strikes, and it's spreading. Egypt's getting hit. You see attacks in the Black Sea and the Caspian. Is the market starting to pay more attention to this than they were, say, 2-3 weeks ago?
You'd have to, because of the price of oil, right? The price of oil is going to hit consumers' pockets through the transition mechanism of gasoline prices and other distillate products, jet fuel, all those types of things. You're even starting to see, I think, probably some fatigue, on behalf of many of the president's supporters, right, saying, we've had a lot of this. We've had enough of it at this point. And you need to start to focus back on domestic policies as well, because domestic policies will come knocking at the door sooner than you think.
Let's not do the midterms yet. It's still July. I just
when people start talking about midterms,
I'm not there.
I think, I'll take the rest of the year off. I'm going to midterms. I'll start talking about, October 1st.
Yes, actually, Labor Day is
That's
when the
what I
market
said
starts to really pay
yesterday. I
attention
said
to it.
I'd give you till September 7th.
End of September. All right.
Well, Monday is August, so you're certainly getting there. But look, you have the underlying strength of earnings. While, look, the market certainly
She's
feels...
trying to comfort us.
No. I'm just trying to give you some facts that you need to think about.
I'll take the therapy. Carry on, please.
Yes, that's right. I've turned from portfolio manager to therapist. So, look, you do have the underlying strength of the equity market. You've got the underlying strength of earnings. Sales growth is really off the charts at this point. And the beats are being rewarded, which is signs of a healthy market. But look, we haven't had a 10% correction in quite some time. Even the market downdraft that you had in late February into early March, that one wasn't a 10% correction. So it's not surprising to see some weakness, a lot of questions about the hyperscalers at this point. Those things need to get resolved, and the Fed is not helping.
Barbara, appreciate it.
Thank you for having me.
Thanks for being here. Thank you. Barbara Reinhard there at Voya Investment Management. This market this morning is punishing indecisiveness. You see that the Federal Reserve punishing indecisiveness by selling the 30-year bond. Meta punishing the indecisiveness of Mark Zuckerberg on the call. And it is indecisive. It's confusing. What direction are they going in? Are they going to be a neocloud player? Are they going to use that capacity for themselves? We still don't really know. That stock is down by 9%. Indecisiveness is getting absolutely hammered in this market. This market right now is unforgiving.
There's too much money at stake right now for there to be such indecisiveness. You need clarity of vision, and if you don't have clarity of vision, people are going to say, ultimately, we don't believe you can succeed.
Futures this morning bouncing back up by 0.4 on the S&P with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. President Donald Trump praising Fed Chair Kevin Warsh, calling him, quote, brilliant after the central bank held rates steady for a fifth straight meeting. Trump saying, I know he'd love to see lower rates, but he's got a political board and they want to keep them up. Microsoft shares rising in the pre-market, the company reporting fourth quarter results that beat analyst expectations. Its Azure cloud unit growing 43% at the fastest rate in 4 years, and revenue topping $100 billion for the first time. On the flip side, Meta shares falling in the pre-market, the Facebook and Instagram owner giving a disappointing quarterly revenue forecast. The company reporting its lowest free cash flow in years, a sign of ballooning expenses for AI. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, striking Iran once again.
We're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it. So it's our turn. And we'll see if we get there with an agreement.
Up next, we'll catch up with the former senior U.S. intelligence official Norman Rule. Live from New York City this morning. Good morning. Two tech stories in the pre-market. Microsoft gets it done. Stock is higher by 9%. Meta does not. Stock is down by 9%. Two very different themes in the pre-market for big tech. Later on, we'll hear from Apple. We'll hear from Amazon. In the market right now, equity futures with a bounce on the S&P 500, up just a little by 0.4% on the S&P 500. On the Nasdaq, entering correction territory, down 11% from the record high back in June. Up this morning by 0.75%, down for the last 5 or 6 days on the Nasdaq. Make it day 6 in yesterday's session. That's the longest run we've seen since October 2022.
There are a couple of issues here. On one hand, you've got the volatility coming from South Korea, questions about competition, questions about CapEx, challenges to that. And then you have this duration trade, the idea that a lot of the debt that some of these hyperscalers have been issuing has been disproportionately on the long end of the yield curve. All of a sudden, when you have 30-year yields at the highest levels going back to 2007, and you have people worried about inflation expectations, that's taking a chunk out of bondholders' pockets right now who invested in the CapEx story of these hyperscalers, and is going to crimp the ambitions to do more.
This market, this bond market, we bought 2s, we sold 30s, and sold 30s really, really hard. 2s out to 30s this morning look like this. The move continues. Yields down at the front end to about 426. Up at the long end to 523. When the Fed chair tells you continuously they'll do something about inflation, then doesn't, this market is going to push back. When the Fed chair tells you that inflation matters and then doesn't act, this market is going to push back. What was interesting yesterday about the dissents is that initially the dissents revealed a preference to hike. And then after the news conference, the dissents just revealed the resistance elsewhere to not do anything at all, led by the Fed chair himself, Kevin Warsh.
There was no understandable explanation as to why not move now, what they were waiting for, what kind of reaction function there is. A reaction function is distinct from the idea of telling you what you're going to do. I'm just going to say that. That seems to be the market's view. Ed Yardeni,
sure.
The grandfather or the father of bond vigilante, the expression, said, in effect, they are saying that if the Fed won't be vigilant about inflation, then they will maintain law and order in the economy, they being the bond market.
Look, it felt like a communication exercise for the last month. We know what that communication exercise was about. We'll talk cautiously, we'll get the market to tighten financial conditions, but we won't actually hike. The thing is, when you actually say the quiet part out loud, which is basically what Fed Chair Kevin Warsh did yesterday in the news conference, the market starts to think, hang on a minute, I'm not playing that game. Like, I'll play along with you a little bit, but I'm not going that far. Goodbye.
Nobody wants to be condescended to. And when somebody says to you, you know what, you're going to do this, and then we're going to all get to the great goal that we're all trying to get to, and just trust me, I'm not going to give you more information, but it's all going to be okay. The seventh grader in us starts to throw spitballs.
I know. Didn't it feel like that yesterday?
That's how it felt.
It felt like being spoken to like you were still a seventh
grader.
But
that's my point. Right? I think that there was a bit of a tantrum because people were saying, hold on a second, I'm throwing the football.
We're asking some big questions.
Yeah, it's like we've been asking them every day.
Is the balance sheet accommodative?
Exactly. Yeah.
Okay. Like,
what's the source of inflation?
You know?
Like, well, what is it?
Right.
A little bit.
Yeah, okay. Crude this morning looks like this. 91 on Brent. WTI around $84 a barrel this morning. Under surveillance this morning, striking Iran once again.
We're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it, but, they tried shooting. So we had 5 rockets shot going 8,500 miles an hour, and all 5 rockets were knocked down to the ground. But they nevertheless took a shot, so it's our turn. And we'll see if we get there with an agreement.
So here's the latest this morning. The U.S. renewing attacks on Iran as the conflict in the Middle East spreads. Vessels in Egypt believed to be the subject of an attack for the first time. Bloomberg's Tyler Kendall joins us now from Washington. Hey, Tyler.
Hey, John, good morning. Well, we are seeing further disruptions beyond the Strait of Hormuz as 2 LNG tankers were hit off the coast of Egypt, which, as you mentioned, does mark the first time that we've seen such an attack in Egyptian waters since the conflict began. Now, no one has claimed responsibility for the attacks, though we do know that Saudi Arabia has been rerouting vessels to use Egypt's Mediterranean coast amid an ongoing threat from the Houthis when it comes to disrupting commercial traffic in the Red Sea. Now, at this point, we've gotten very little public indication that Iran is willing to let up its leverage when it comes to commercial shipping, though I will point out that within the last hour, we heard from Pakistan's foreign ministry, of course, a key mediator in this conflict, say that negotiations between the U.S. and Iran are, quote, ongoing, and that there is this big focus on reopening the Strait of Hormuz. New data out this morning does show that there has been at least a slight uptick in traffic, even amid this flare-up in fighting. Research from Kettner finding that 14 vessels transited through yesterday, up from the single digits that we saw last week. Though we have to say, President Trump has really kept that escalation and the threat of further escalation on the table, with this latest attack just coming hours after he vowed to retaliate for Iran's surprise attack against U.S. forces earlier this week. Now, John, we did hear from a senior administration official who outlined that yesterday's overnight wave of attacks was larger in scope than previously believed, though it doesn't mark a resumption of full major combat operations.
Tyler Kendall with the latest in Washington. Tyler, thank you. More from Tyler in the next hour. Here's the take from the former senior U.S. intelligence official Norman Roule. He writes the following: diplomacy is not dead, but there is little evidence that it will succeed soon. Norman joins us now for more. Norman, sir, welcome back to the programme. What are the necessary conditions required to offer a sustainable diplomatic solution? What do we need to see happen here?
Good morning. We need to see Iran drop its maximalist demands. At present, Iran is demanding effective control of the Strait of Hormuz, which would give it a stranglehold on the economies of the Gulf countries, an ability to access or interrupt their fiber optic lines, and an ability to impose pain on the entire global economy. Until that changes, you're not going to see a substantial shift in the regional dynamic.
Norm, at the start of the conflict, the administration, as well as the Israeli military, was going after top brass of the Iranians. Right now, it continues to be from CENTCOM, military command centers, missiles and drone facilities, coastal surveillance and defensive sites. Do you think they're going to continue targeting these types of assets, or can we see it spread once again?
In the near term, the U.S. strategy appears to be consistent. Washington is dealing with this in a vertical approach. It's expanding attacks in Iran against targets that would degrade Iran's capability to strike the U.S. and shipping. Remember, just as we may have munitions restraints, so do the Iranians. At the same time, the goal of the U.S. is to shape the debate within Tehran to bring them to a diplomatic table. Going against energy, infrastructure might actually harden that debate. Now, the Iranian response is to work horizontally and to widen the geography as much as possible to bring international pain against the United States to cease these attacks.
Is there any evidence that that debate is actually happening in Tehran?
There is evidence of a debate, but there's no evidence that debate is moving in the direction that we might wish. Indeed, there are hardline actors who would contend that Iran needs to take an even tougher position against the international community and against the U.S. Because remember, if Iran controls the Strait of Hormuz, this is a vast amount of routine and regular money that would be largely difficult for the United States to constrain via sanctions. If, again, the system is approved, that gives Iran fees. So Iran is going to aim for that target.
Norm, how much have the bases, the U.S. bases in the region, have been how much have they been compromised over the past couple of months of fighting?
Well, the U.S. has not maintained a large presence in the region per se, other than for training, air defense, and other activities related to that. Over the recent years, the United States has actually withdrawn a number of its elements to the United States. We manage wars from the United States and from the aircraft carriers in the region. Now, that's not to say these aren't important. There are partners there. We do have a military presence there. But for the large part, the war is conducted from the United States.
Norm, how much is the fact that Saudi Arabia has now entered this conflict open the door for other Arab partners?
Well, we're watching the gradual fading of red lines of Gulf countries to be involved directly in this conflict. Now, again, the conflict is spreading into a multi-theater war. And in addition to Gulf actors, we've had the Ukrainian strike on an Iranian ship in the Caspian. So what is happening is the red lines for other actors to strike back against Iran to demonstrate they're not going to be punching bags for Iranian weapons. That is gradually fading, and that trend will likely continue. Although the Saudis and others will push for de-escalation and to try to keep the region calm.
Norm, it's always good to hear from you. Thank you, sir. The former senior US intelligence official, Norman Rule, there on the backdrop in the Middle East right now. The conflict is spreading clearly. It's involving more countries. It's involving more military assets across the region. And it's not just the Middle East that's of concern. More so, really reasserting itself in the last, I would say, 2 months, is the situation in Russia. And crude product is something you'll hear more about a little bit later in the program.
Right. The Russians, first off, have an export ban because of this. You see the Ukrainians hitting vessels in the Black Sea, in the Caspian Sea. It is now a multi-front war, not just the Strait of Hormuz. We have to care about what's going on, as well as the Bab el-Mandeb Strait and the Red Sea. On top of that, reports overnight about Egypt and potentially this drone that hit vessels in Egypt. This is starting to metastasize. At the same time, reports yesterday, China is sending military hardware to Iran. This is becoming multi-country, multinational, and spreading geographically.
Paul Sankey of Sankey Research joining us in the next hour on crude and oil product. Up next on the program, let's talk tech. Gregg Moskowitz of Mizuho on Microsoft's massive cloud growth. That stock is up by 9% in the pre-market. Equity futures bouncing back on the S&P, up by 0.5, on the Nasdaq up by 1%. 6-day slide on the Nasdaq 100, the longest since October 2022 for the semis, down for 5 consecutive days. That's the longest run so far this year. This is the bounce, helped out by Microsoft. We'll talk about that name in just a moment. Microsoft getting it done. Meta did not. In the bond market, check this out. 2s, 10s and 30s. 2s got bought, 30s got sold. 2s this morning down again, yields lower to 426. 30s up 2 basis points to 522. That was one of the biggest Fed day steepenings we've seen, going all the way back to the 90s. Look at the curve. 2s out to 30s. This is how much steeper things are right now. That's on intraday. You take that chart back, let's say a couple of days or the last year or so, you'll see a major spike higher in just the last 24 hours, speaking to the questioning of the credibility of this institution.
Yeah, it was more than 8 basis points yesterday of steepening. It was the most going back to April of 2025 on a Fed day. It was the most going back to March of 2022 when they did that 50 basis point rate hike. And before that, it was taper tantrum day in 2013. So yes, it is one of the biggest steepenings. And this one was led by the long end, of feeling that maybe this Fed was not as committed to anchoring Fed inflation expectations.
And Kevin Warsh coming out and telling the market to play the ball, not the referee. I love what Robert Armstrong of the FT had to say about that. He said it doesn't make any sense. The Federal Reserve is not the referee. You set interest rate policy. You are a player. What do you expect the market to do? And I think that's where it felt like he was almost talking down to financial market participants.
I almost feel sorry for Warsh this morning because he's going to take a beating from everyone, from all different kind of directions. But you're just absolutely right. Neil Dutta said the same thing yesterday. To claim that the move between meetings was about the data and the market coming up with its own ideas about what was happening, when it was clearly responding to several speeches from hawkish Fed officials going into the quiet period. I don't know if he is misleading us, attempting to mislead us. I hope he's not, but come on. If you follow this market, you knew that didn't really stack up.
You're not a passive player here, to your point. You're an active one, and there's clearly a role that all the Fed officials who came out in the interim and talked about the potential to raise rates had a clear influence on why the market was pricing in a greater degree of rate hikes and a greater degree of hawkishness. So that didn't really ring true. A lot of it didn't really seem to make sense to markets, and so the only conclusion they could come to was this might have been either political or a belief that they could just drive on the market into submission.
That's the new metric right now. It's the 30-year in the 520s. That is going to be put alongside every single Fed chair Kevin Warsh speech for the rest of this year. And it's going to be used to measure his inflation-fighting credentials for the rest of this year. That's it now. Everyone's going to talk about this.
There are 2 metrics. I think that it's that one and the idea of the 30-year and just what it does. And then it's the dollar. And if you do have the yield move going up, as Torsten Slok was saying, with the dollar weakening, that tells you all you need to know about credibility.
Which I've got to say is unfortunate for the Fed chair because there's so much else going on that's leading to high yields at the long end of the curve. But that's where we're at. That's the conversation. 520 something on 30s this morning. Counting it down to the open about 3 hours away. Let's get to your morning move as Yahira has more. Hey, Yahira.
Hi, John. The contrast between Microsoft and Meta results is clear looking at this board as investors reward the company that is showing clearer returns on AI spending, and that is clearly Microsoft. As it said that its cloud revenue its cloud unit rose at its fastest pace in 4 years, and its CFO indicated that Microsoft would hold the line when it comes to any new capital spending. But at Meta, Mark Zuckerberg showed a more muddied picture, and that was a problem there. A lot of analysts wanted to hear more about this cloud computing opportunity, but they did not get that. Instead, Meta delivering slower, softer revenue growth and a dramatic decline in free cash flow. Turning to the chip sector and getting a gauge on the smartphone market as well, with Qualcomm, shares are falling 5.4% after it delivered a disappointing forecast due to problems we've heard about repeatedly, component shortages and higher costs, which have been weighing on the entire smartphone market. But of course, it's a problem when that is your biggest business by far. And we end on a check on the consumer with Starbucks and Chipotle both delivering a beat and a raise. Shares are up more than 6%. The results suggesting the consumer is not pulling back across the board. They are willing to spend if you give them something that they want. Both companies, Starbucks and Chipotle, said that new menu items is what got customers through the door. John?
Yahira, thank you. Appreciate it. I looked at those 2 names in the pre-market earlier on this morning, thought the same thing. You look at the rest of the economy right now, away from tech. Look at the consumer stories. They've held up pretty well through the week.
To me, this is actually the story. The idea that tech has had a lot of drama spurred by how much shares have gone up. But when you look at the other companies, and just to be clear, so far about half of the S&P 500 has reported earnings with earnings growth of something like 28%. I mean, it's been absolutely astronomical in terms of the gains. You start looking at this and you start saying maybe there's a reason for the optimism that people feel.
Tech scare, not a growth scare. We've said that repeatedly, at least not yet. On our radar this morning, the US striking dozens of Iranian targets, responding to attacks on American forces in Jordan. The conflict spreading across the region after unclaimed attacks on vessels at an Egyptian port. Elsewhere, a tale of two hyperscalers. Microsoft shares rising after posting its fastest quarterly growth in 4 years, with cloud revenue rising more than 40%. Meta shares plunging following a disappointing forecast and reporting its lowest free cash flow in years. And finally, the Fed chair, Kevin Warsh, calling on markets to do the work.
Participants are learning to play the ball, not the referee. Markets can be a very good source of information. So they're gauging themselves how restrictive the Treasury curve should be. Even while at some level we haven't done much in 42 days, the markets have done quite a bit. They are working in concert to keep us on our toes.
Markets have done even more in the last 24 hours, pushing 30-year yields to 19-year highs. And I just wonder how much of a good source of information that might be for the Fed chair waking up to this.
I was thinking the same thing, that essentially Fed Chair Kevin Warsh went to the market and said, show us what you got. And the market said, well, here you go. The highest 30-year yield going back to 2007, massive yield curve steepening. How do you like them yields? And this is the question. How does he respond? Does that, to Torsten Slok's point yesterday, sort of ensure that there's going to be a rate hike that much more in September to offset some of the tightening that we've seen?
Bank of America questioning the same thing. It's going to come down to the data between now and then. They're going to need some soft prints to bail them out of that communication problem in the last 24 hours.
If you don't get it, you're only going to get ongoing steepening, which you're seeing today, and you're going to get a weaker dollar. And until you get some Fed rhetoric that can give more explanations that are somewhat understandable, this market is just going to keep on going in the direction it is.
At least he's kind of Jackson Hole. You saw that commitment to a news conference at every meeting, a Jackson Hole speech too,
yeah,
right?
I mean, but you know,
blank page at the moment. But
I'm not sure how many people were happy with the commitment to every news conference, every meeting for the rest of this year after that performance. But
especially because he said that he'd have something to say, and then one person said, "What was it that you just said?" And he said, what was it that you just accomplished? And he's like, well,
He had easy reasons, though. We had good CPI. He could say there's a geopolitical conflict that's pushing up oil that we need to see how it's going to be resolved. He had reasons to really lean on and just decided not to.
The most important line from this Fed meeting was made before this Fed meeting even took place, and it came from Chris Waller, the Fed governor, in that speech, when he said sternly staring at inflation until it melts before our withering gaze is not an option. I actually thought it was the most powerful line we've had in Fed speak for the last several months. And that was the line we were all thinking of in the news conference as Kevin Warsh was saying nothing and indicating they wouldn't do anything anytime soon. That's what we were all thinking of. The words of Governor Chris Waller.
Yeah, I loved Neil Dutta's comment, which is evidently staring at inflation with the withering gaze is an option, because essentially that's what just happened.
The 30-year in the 520s. Let's turn back to the tech story, a better story from Microsoft. The tech heavyweight delivering a better-than-expected report with cloud compute revenue topping $100 billion. Gregg Moskowitz of Mizuho maintaining his outperform rating and raising his price target to $510. Gregg joins us now for more. Gregg, welcome, sir. It's good to get some time with you. I'm sure it's a busy morning following a busy afternoon for you and the team. The stock is up in the pre-market, up quite nicely. What did Microsoft manage to do yesterday that Alphabet struggled to do a week before?
Well, thanks so much for having me. It's always good to be here. It really comes down to Azure. Everything begins with Azure when it comes to Microsoft, and they had guided to 39 to 40% year-over-year revenue growth. The investors were looking for 40 to 41. I would say 41% at the most. They delivered 43. This is the most significant upside that we have seen in quite a few quarters from Microsoft. And then what's also very important to note is that as it relates to Q1 guidance for the September quarter, the street was at 40 to 41%. They guided to 45% constant currency growth, just a massive beat. And I will also say that there's been an impression among many investors for at least a few months now that Microsoft has sort of lost its mojo when it comes to Azure. They've seen the massive acceleration at Google Cloud. They've seen AWS accelerate. They've seen some other developments, competitively speaking. And I think Microsoft resoundingly showed last night that they remain very strongly positioned in Azure, and certainly they projected a lot of confidence as well. And so that effectively, to me, is why we're seeing this move today.
How much of the move is also attributed to the fact that CapEx spend and the plans for the upcoming year were lower than people had expected, only $175 billion versus the expectation of $190 billion?
Right. So it's a good question, Lisa. The only clarification I would have there is it's not quite apples to apples. They've made an accounting change in that they've taken their data centers and their office buildings, which used to be amortized over a 15-year period, that's now being amortized over 25 years. And so they had previously guided to $190 billion of CapEx for calendar 2026. They said that amount of spend is unchanged, but based on the accounting change, it actually goes down to $175 billion. So effectively about a 10% difference in terms of reported CapEx in year one as a result of this change, but overall no alteration, so to speak, in the trajectory for 2026 CapEx.
How much is the tell of this earnings season free cash flow? Alphabet really punished after their first free cash flow negative quarter as far back as the data goes. And then you had Meta also with free cash flow coming in at the lowest level going back to 2022, while Microsoft actually had a pretty decent free cash flow number that came in. Is that the true tell right now in terms of market performance?
Yeah, I will say, broadly speaking, there is absolutely increased attention on the ROI of all of these investments. This, very large increase in CapEx that we've seen across a number of key players in this space. And so, yes, there's increased scrutiny on the free cash flow that will be generated. Now, I will say Microsoft did not provide explicit guidance for fiscal 26 CapEx. So we know the first couple of quarters, roughly speaking. We don't know the back half of the year. Microsoft did say, though, that free cash flow will still grow in fiscal 27, no matter what. So that provides a little bit of a guardrail, if you will. But again, still some uncertainty. And I think it's reflective of the fact that there's just extremely strong demand for AI workloads at this time. I think everybody knows that. And these companies are all racing to fulfill or service as much of this demand as they can. But naturally, there's a great amount of scrutiny, understandably so, on the returns from these investments.
I know you're really focused on Azure. Where are Microsoft now in the race in terms of maybe catching up to AWS?
So certainly AWS remains the largest in terms of cloud compute oriented revenue. Microsoft does continue to grow faster, and we're really impressed with kind of what we saw this quarter. And one other thing that I will note as well, which doesn't always get as much attention as perhaps it should, but this, 4 points of acceleration that they just showed in the June period, 43% growth versus 39% in March, is also coming versus a compare that is 4 points tougher. And so it's really unusual for a business this size to show that kind of acceleration against a comp that is so much more difficult. So again, really underscoring some very good momentum for Azure right now.
Gregg, appreciate your time. I know it's a busy one. Gregg Moskowitz there of Mizuho on Microsoft. Much better numbers from them. Microsoft a real standout performer for the Mag 7. We will hear from Apple and Amazon after the close. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Poland's Prime Minister Donald Tusk saying an object that crashed near its border with Ukraine was a Russian missile. Tusk says the incident took place at around 3:40 a.m. local time during an intense Russian attack targeting Ukraine. Wildfires in Europe now forcing evacuations of the island of Crete. Cooler weather is helping firefighters gain control of blazes in parts of Spain and France. In eastern England, a large wildfire has broken out near a nuclear power plant as hot, dry conditions grip the UK. And Shell reporting second quarter earnings that beat analyst estimates. The British oil company saying its profit more than doubled from a year ago as it benefits from the increase in oil and gas prices. And that is your Bloomberg brief, John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, the bond market showing up to play.
It was a real family fight. That's the better way to get policy right. That's our North Star. Market participants are learning to play the ball, not the referee.
Up next, Francis Donald of RBC. here's the bounce in stocks this morning, up by 0.5 on the S&P, on the Nasdaq following a 6-day slide. The Nasdaq 100 higher by 1%. In the bond market, want to do something slightly different. Let's talk about the yield curve. 2s are rallying, yields are down a basis point. 30s are selling off, yields are up 2 to 522. That was the story yesterday. The moves were much larger than that. And the front page of every financial newspaper this morning, every Wall Street note you can think of, is all about the same thing. The question to follow through. Are they willing to follow through at the Federal Reserve and do something about above target inflation? And we're questioning the credibility of this institution. I get it. I understand why those questions are there. We're all asking them. There's an additional question I think we should spend a little bit more time on. The preferred tool to address the inflation if they do follow through. There was just a hint of that from the Fed chair yesterday in this quote. If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. And then he gave a little bit of a nod to the balance sheet. Now, if you believe that's a revealed preference, then the bond market's doing exactly what it should do. Yields down at the front end, up at the long end. And I wonder how much more we'll be discussing that over the summer.
If this is another tool, that means they could potentially reduce their balance sheet further, not buy as many of the long-term treasuries, and thus it would make sense to see yields creep higher on the long end.
Let's do something different. Let's talk about the bond market and what's happening here instead of just, I could do this all morning.
I know, I think it's great.
Right, but we'll do something different.
Talk about BS, the balance sheet.
Right, that kind of BS. You really are hurt by yesterday, aren't you?
Wow, Lisa's face
It was just, you could feel it.
Wow,
you could
it
feel
is
it.
something else.
Well, let's just move on.
Bramo was just not happy. Don't talk down to Lisa.
Nope.
Just don't talk down to Bramo.
Maybe I just wasn't understanding.
Maybe, maybe. Under surveillance this morning, the bond market showing up to play.
It was a real family fight. That's the better way to get policy right. That's our North Star. If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. Market participants are learning to play the ball, not the referee.
So here's the latest this morning. The bond market questioning Fed Chair Kevin Warsh's commitment to the fight against inflation, pushing 30-year bond yields to the highest level since 2007. Francis Dolan of RBC writing, Warsh is going to have to spend the next few meetings addressing why he remains so committed to addressing inflation by keeping monetary policy on hold. Francis joins us now for more. Francis, good morning.
Good morning.
Did you react the same way Lisa did to that news conference yesterday?
I had many reactions, but so too did the market. And it occurred to me as I was watching the 10-year, the 30-year move that we were all effectively going through the 7 stages of grief. There was shock at the communication style. There was some denial from the press corps. What do you mean we're not going to get forward guidance? Some real anger at the long end of the curve. Where we're not just yet is that reconstructing how we're going to think about the Fed and full-on acceptance that we are not going to get a Powell or Yellen or Bernanke style Fed with the Warsh Fed. And the one line that I clued into is a line that everyone has been quoting, but maybe focus on the wrong word. There was the line from Warsh, the markets are learning how to play the ball, not the referee, which I love as an economist because the ball is the economic data. But I clued into the word learning. He's indicating he understands, and we should all understand, this is a transitional moment. We may not have a full picture of what this new framework is, and so there will be some volatility as we adjust to it. Is it a permanent volatility, or is it a adjustment phase?
You think this is part of the process?
Well, it's part of a process of moving from one style to another style. And now the next iteration of that is, can we really wean ourselves off and focus on the econ data ahead? So we've got a lot of econ data just today that could be very informative about the path of inflation ahead. As opposed to looking backwards at where the data has been, we're going to have to start getting much better, much stronger, much more reactive to the future path and all of the data that goes into it.
At the same time, the rise yesterday in the 30-year yield wasn't driven by inflation expectations. That was driven by real yields. And you could see the real yield at the highest level going back to 2008. It was driven by a dollar that normally strengthens when you get higher yields. In fact, it weakened. This did seem to go to a sense that this Fed was less determined to keep inflation under control. Do you think that's the wrong takeaway about what it means to have this new communication style, this new Federal Reserve?
Well, what occurred to me over the time is, while we're very concerned about inflation and lots of reasons why, there's breadth, there's a lot of longer-term inflationary pressures in play, there is a reason to stay on hold when you have a core PCE that will print at 3.3%. And it is that, while a lot of the drivers of inflation are supply side and not particularly rate sensitive. So there was an argument to be made here, and could have been made, made. We are on hold because we are assessing whether rate policy reactions is the right tool to address this inflation, which is hurting consumers. That would have been a pretty easy off-ramp that wasn't used this time. Maybe we'll see it in future communications.
So if you're past the 7 stages of grief, do you think that this market is mispricing some of what we heard yesterday? Do you think that the anger at the 30-year is misplaced and that you'd be buying that?
I'm feeling some relief and validation from the markets that we're now cluing in a little bit more to some of the upside risks here. We've had some complacency when it comes to inflation. Now, Fed Chair Warsh, of course, talked about 5 years of inflation above. It's 5 years, 4 months of inflation above 2%. But there is 39% of the CPI basket is running above 3% right now, including just about everything that Americans buy regularly. Food, electricity, rent, God, coffee prices are a real issue, childcare. All of these things that Americans buy are really problematically high, and consumers are feeling that pressure, particularly at the lower end. So acknowledgement that this is a problem in markets and by the central bank is what frustrated me last year under the Powell Fed that we're now starting to see a reconciliation of.
What do you make for the rest of the year then? September, certainly live?
All meetings are live, and that's the intention, of course, of where we're moving forward. But if we're correct and inflation is going to stay sticky, the odds of rate hikes are going to need to climb. And if we don't get rate hikes, well, then we'll get other forms of market responses to that. The question is, does this actually rectify what's happening underlying inflation? Because, the conflict in the Middle East, which is broadening, we've seen headlines just this morning, AI development somewhat rate sensitive, but not fully. That super high income consumer that's holding up this consumer ship, they may actually get wealthier off of higher interest rates coming through, and tariffs are back in play. This doesn't seem to be headline news at all, but we have new Section 301 tariffs that should have been the end of tariff pressure in Q2 that are coming back online. So are these higher rates in the market going to actually impact the inflation ahead? This is another form of reconciliation we have to address.
Just to pick up on one thing you said, high yields might lead to more spending at the upper end of the K.
Well, we're just thinking differently about the consumer than we might have in the past.
I'm open to that.
When you have, there's a huge Venn diagram overlap between our high income, very wealthy consumer and the demographic attached to it. So if they actually are more, they have more concentration in high yield or any yielding investments, then you could actually see a wealth impact from that as well. Of course, it's offset by other elements, but this is not the same consumer that we had 10 years ago, and their reaction function to stock market volatility or bond market volatility, it looks different. At the end of the day, though, you want a house, you're not feeling great today about that rise in the 30-year. You hold debt, you're not feeling great about some of those market rises there. So we just have to think in a way that's more fragmented with the consumer than just one profile for all.
Therapy Thursday. Appreciate it. Thank you. Needed it after yesterday, to be honest with you. Francis Donald of RBC. I can think of one person that needed it more than I did. And they might be sitting around this table.
Okay,
right now.
I'm going to take a deep breath, and I'm going to be an open mind that, maybe we're all just looking at it wrong.
We're going to see a different Bramo in the next hour.
I think so. I've been slapped down.
I've got my doubts.
I now
Who
have
slapped
therapy.
you down? No one slapped you down.
I feel humbled. Maybe I just don't
by who?
correctly. I didn't just it.
Bramo. Do you? Everyone loves that.
Yeah.
All right. Up next, Max Kettner of HSBC, Paul Sankey of Sankey Research, Nick Jones of BNP, plus the St. Louis Fed president, the former Jim Bullard. That's next. This is Bloomberg.
Still in an environment where tech is contributing the lion's share of earnings.
The markets can't go up without tech going up.
The bar is just being set too high.
We're going to remain in a choppy market for tech stocks.
It's just time to take a deep breath and own the best names in the sectors.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this. Futures positive by 0.5 on the S&P, bouncing back on the Nasdaq following a 6-day slide up 1 full percentage point. In the bond market, 2s, 10s and 30s questioning the credibility of this Federal Reserve. Yields down at the front end by another basis point, up at the long end by another 3, 5.23 on 30s.
Yeah, this is a move that's getting a lot of people's attention. Highest 30-year yield going back to 2007, highest real yields going back to 2008. And how much is this really pushing back against the Fed, saying the Fed's watching the market's saying, well, you've got an inflation problem and you need to get policy under control. Look, I'm breathing. I'm touching grass.
Take a deep breath,
I'm
Bramo.
taking a walk. Because ultimately, this story has yet to be written, and we'll have to wait to see what the Fed comes out.
It's a process. We're working through it. All
Maybe
right.
it's 7 stages of grief.
Where are we? Not at acceptance yet. Are we getting closer?
It's a long week.
OK. Got some symmetry for you. Yesterday at the Federal Reserve, a hold and 3 dissents. This morning at the Bank of England, a hold, and I see 3 dissents. Let's get to that. With more, Lizzy Burden is outside the Bank of England and she can break it down. Hey, Lizzy.
Well, John, much like the Federal Reserve last night, it's a hawkish hold from the Bank of England, a 6-3 split. That's more hawkish than was expected. Catherine Mann joining Chief Economist Hugh Pill and external member Megan Green in dissenting for a quarter-point hike. Mann that this hike was needed for credibility, but she couldn't persuade the rest of the committee. For now, the data gives them cover. Excuse the police car just going past. The data gives them cover to stand pat. We did, of course, have inflation coming in below the BOE's expectations in June at 2.6%. And the reason that they want to wait for clarity is not just the geopolitical uncertainty, but also the fiscal uncertainty around Andy Burnham. Do we think that maybe he'll go for some more borrowing when it comes to the autumn budget down the track? But, of course, the exposure to international energy markets, the big factor here. Just interesting in terms of the guidance, it's unchanged, but they say there isn't evidence of second-round effects yet, but they're split on in terms of what the likelihood of second-round effects would be down the track. And they're saying as well that they have various scenarios of what inflation could look like in the future. In the mild scenario, it peaks at 3% in Q4 2026. In the adverse scenario, it peaks at 4.5% in the second quarter of 2027. So a range, again, as we have seen in previous times, rather than a central forecast with variance around it. So it's interesting given that, as well, we've had so many swings in the oil price. These projections are perhaps a bit mouldy on arrival, John, but just looking at the market reaction, the pound is up 0.2%, which is pretty much where we found it before the decision. So now we're looking ahead to the press conference with Andrew Bailey later on today. European viewers, by the way, can be watching it on Bloomberg TV with the opening trade team's analysis. And I'll be there as well. We'll have it on the terminal, Bloomberg.com and YouTube for other regions as well.
Lizzy, get in the office. Get away from the sounds of the City of London. Lizzy Burden there with the latest. Unchanged, 3 dissents. Very similar to what we saw yesterday at the Federal Reserve. I would say the difference is probably going to be Governor Bailey versus Chair Warsh. I think the outcome of that news conference might be slightly different.
It also is different because the expectations were lower. People weren't expecting that degree of dissents, although in the U.S. they weren't expecting 3 dissents either. I will say that's where you see it in the pound. The fact that the pound held steady, strengthened a little bit after the decision was released, and that gives you a sense of how the international markets are viewing this.
Let's get to the view on Wall Street this morning. All talk, no action. Fed Chair Kevin Warsh's indecisiveness leaving the bond market questioning the Fed's credibility. Max Kettner of HSBC writing the Fed narrative has moved from a bias to ease to a willingness to hike. The decision not to hike has therefore prompted some modest recalibration of rate expectations. Max joins us now for more. Max, welcome and good morning. How modest are those moves in that yield curve?
Yeah, I think yesterday, I mean, I'll try to maybe perhaps to do a little bit of a better job in answering questions in the next 10 minutes than what we've had yesterday, although I don't think the bar is particularly high. Look, I think when you look at the yield curve move yesterday, that's been basically the bond market voting with their feet. But I think one of the things that we also need to bear in mind that particularly in the last couple of days, positioning particularly from fast money really was moving towards, OK, they might be actually doing a hike. And if not a hike, then he's going to sound very, very hawkish, really to hammer down that message around credibility that he's managed to manifest really during his first press conference in the June meeting, right? And now we've got the complete opposite. If you look at the yield curve move, you just look at 2s, 5s, 10s, 30s, you look at that, the reaction after the June meeting, you look at that after yesterday, it's the exact opposite move. So I was a bit puzzled yesterday. Why, what's the incentive of doing that? What's the incentive of dodging every sort of question around the Fed's hawkishness? To me, that is, slightly up for grabs, that question.
Max, yesterday everything got sold. Equities got sold. The long end of the bond market got sold. The dollar got sold. The Fed's credibility got sold. Max, what's more instructive for risk? Is it the move at the front end of the curve or the longer end of the curve?
No, I think it's more the longer end. So if the longer end really starts to be properly unhinged, both 10s and 30s, I think that will be an issue for equities and for credit, for EM assets, really for everything from FX to credit to equities. Because the issue is, I've talked about this here in this program for months already, is that we've been ignoring what we call that danger zone, right? That danger zone, the level of yield on the long end that normally triggers really a risk-off reaction across all the asset classes, whether it's risk-on or risk-off assets, right? So it also includes things like gold, for example. That's what we've seen yesterday. We have been able to ignore that so far because the earnings picture has been so strong. And that yet again is the case now with the Q2 reporting season. Once again, we have these broad-based earnings surprises. But of course, if the bond market, and particularly the long end, starts being unhinged and the volatility there is too high, that drags probably volatility in rates across the curve higher, and that puts a dent on valuations, not only on PEs, but really across the asset class spectrum.
Before we got earnings, Max, you were on the edge of getting a little more bearish. Not getting bearish, but just not getting as bullish. Then you reversed that after we got a number of these earnings. They came out so well, and the responses, at least from Microsoft, have been positive. Does anything change with your call based on the reaction that we've seen in the long end of the yield curve?
No, so I would give two answers to that. Number one, from an asset class and from an asset allocation perspective, no, not at all. If you look at things like equities over treasuries, so you look at the relative performance between those two, you would not think that in the last 2 months there's been such mayhem in parts of the equity market. So the equity market overall is doing fine, right? If you guys were to look at charts like the equal-weighted S&P or look at equal-weighted global indices, look at things like the topics, look at things like European stock markets, right? The stock 600. There's nothing to see. We're pretty much at or very close to the all-time highs. It's literally just tech and just semis where we've seen that weakness. And that brings me to the second answer. Now, going forward, the question is that tech weakness, that semi weakness, is that going to drag us down? Is that going to drag beta down across the risk asset spectrum? Or are we done and are we going to rotate back into tech? Are we done with that broadening trend that we've been on for the best part really of the last 4 weeks? Is that done in the next couple of weeks, or is that going to now manifest itself into broader risk off in August? I think that's the question now.
Max, the broadening out trade that people were talking about earlier this year included not just the United States and the non-tech names, but the rest of the world. And I just wonder how much you're doubling down on the rest of the world aspect, especially given the greater degree of volatility around U.S. policy.
Yeah, absolutely. So we are still overweight and quite a lot overweight in Japan and particularly in Europe. So when we were closing at the start of July, our overweight in emerging market equities, simply because we were obviously not foreseeing how big that drawdown would be in Asian memory names, but we were uncomfortable with that pretty high volatility and with those wild swings already at the end of June and the first week of July, hence why we've taken off emerging market equities in particular and put that into Europe and into Japan. Now, if you look at things like Europe, in fact, European equities, they're pretty much the same line as the equal-weighted S&P. So I don't think, Lisa, right, I don't think it's rotating out of the US. It's more about, are we going to buy the equal weight? Are we going to buy the rest of the S&P, or are we going to rotate back into tech and semis? For me, we're not quite there yet. We're not quite at the level where I want to say the broadening is done. I don't want to buy the other half of the S&P, the non-tech and AI S&P, that stuff that we bought in the last 4 weeks. I want to go back into tech and semis. I think the technicals are not just quite there yet, but I think that is just a matter really of weeks. It's not something we're like, well, at some point in the next couple of months, given how strong that drawdown has been, particularly also in the global momentum names, I think that is a matter of weeks, if not days, until we can really switch there around. The one thing that I would say is, it's definitely not, in our view, something where global risk and global risk assets, equities, credit, high beta effects, is going to drag down by that momentum sell-off. We've seen such a big sell-off already. You know, that means going forward, you're going to have to create a big catastrophe scenario. You're going to have to see an even bigger drawdown now going forward for that to spill over into a broader risk-off.
So, Max, bullish kinda. Is that a decent summary of where you're at right now?
Yeah, absolutely. I think I would say max bullish, but it depends what you buy, right? It's not just like, well, I'm just going to buy tech and I'll sleep. No, we were buying the wings of the world, right, up until a month ago. We were buying Asia and we're buying the US, and particularly the tech names. For us now, it's still really max bullish, but it's the broad-based one. It's the second earnings season in a row where not only in the US, but also globally, people have once again been going on about how high the bar to beat is for earnings, and they've been once again underestimating how strong and how broad-based the earnings impulse and the earnings recovery really is.
Max, good to see you, buddy. As always, Max Kettner there of HSBC on this Federal Reserve, on this earnings story. And Lisa, you said it at the start of the week. I was saying repeatedly the week begins on Wednesday. We have these massive events coming up, and you were talking about the earnings elsewhere, and you were absolutely right. The earnings elsewhere have been pretty tremendous.
Yeah, I'm long a triple frapped, half decaf, half calf, 2%
with a Coca-Cola,
Frappuccino with a Coke. I mean, that's essentially where we're at. Well, no, it's just the idea of Starbucks, the fact that they just need to figure out how to get enough food to cater to people who want to pay a lot of money for all this food. I mean, it just gives you a sense of how strong the economy is.
How much caffeine did you need yesterday? Or something stiffer after the news conference,
yeah,
right?
You need a lot of caffeine for that.
I need to just get used to a style. You know, I don't know what he was trying to accomplish. I actually, if I could ask one question this morning and get a candid answer, I would say, are you happy with the reaction in markets? Because if he was, and I guess we'll get the answer to.
Is it by design?
Is this by design, or is this, you know, a communication error that you can?
We should just start having whatever TK's having in the news conference.
I think I might have to.
Right? Just get through it. So much easier. Let's get you an update on news worldwide this morning with your Bloomberg brief. Let's get to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The Bank of England mirroring the Fed, announcing it's holding rates steady with 3 dissenters calling for a hike. The committee saying they stand ready to act to stop high inflation from lingering. Moonshot AI securing a $35 billion valuation. Sources telling us here at Bloomberg that's far more than the Beijing-based startup was aiming for. The company now seeking funding at a valuation of $50 billion. It's aiming for an IPO in Hong Kong as early as this year. And a blowout quarter for Samsung, South Korea's largest company, posting a 250-fold surge in chip profits, driven by demand for high bandwidth memory and storage. Samsung echoing comments from SK Hynix, saying it doesn't expect a let-up in the speed of AI development and data center construction. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you very much. Up next on the programme, Iran, back under fire.
We're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it. So it's our turn. And we'll see if we get there with an agreement.
Paul Sankey of Sankey Research up next, live from New York City this morning. Good morning. After the close, coming up a little bit later, we'll get earnings from the likes of Apple and Amazon. Looking forward to that. Equity futures on the S&P 500, positive by 0.5 on the S&P, on the Nasdaq, up by 1.2 on the Russell, up by 0.4 in the bond market. Some pushback against this Fed chair. 30-year yields are higher by 2 basis points, 522. You know, I keep saying that, and I keep wondering afterwards, is it pushback? Is this ultimately what he wants? To your point, Bramo, is it by design?
You know, I would argue not really, because you don't want to see the dollar fall and yields go up. That is a toxic brew for any central banker, especially given the fact that it isn't necessarily coming from inflation expectations going up. So this raises a question fundamentally about Fed credibility and whether this market is going to inject an ounce of pain into this Fed's discussion.
The Fed's credibility got repriced in the last 24 hours. It got sold. In the commodity market, Brent and WTI shaping up as follows. Brent holding on to the 90s at $90.30. Under surveillance this morning, Iran back under fire.
We're going to be hitting them very hard because it's our turn to hit them. They know it's coming. They're asking us not to do it, but, you know, they tried shooting. So we had 5 rockets shot going 8,500 miles an hour, and all 5 rockets were knocked down to the ground. But they nevertheless took a shot, so it's our turn. And we'll see if we get there with an agreement.
So here's the latest this morning. The US retaliating against Iran, failing to stop the conflict from spreading as Tehran strikes American and Arab targets across the Middle East. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, Iran's retaliation to the U.S.'s retaliation is hitting across the region, and disruptions to commercial shipping are extending beyond the Strait of Hormuz. Overnight, 2 LNG tankers were hit off the coast of Egypt, and while no one has claimed responsibility for that attack, there has been this heightened focus on Egypt's Mediterranean coast, as Saudi Arabia has been rerouting ships there in a bid to avoid the threat posed by the Houthis in the Red Sea. At this point, there's been very little public indication that Iran is willing to let up its leverage when it comes to commercial shipping. And we saw this new data show, though, that there is this slight uptick when it comes to traffic in the Strait of Hormuz. Research from Kettner saying that 14 ships transited through in both directions yesterday, up from single digits last week. But importantly, almost all of these vessels are using that Iranian-approved corridor. Now, importantly, we did have the U.S. Energy Secretary Christopher Wright on Balance of Power last night, who told us that on average we are seeing 13 million barrels per day leave the Persian Gulf over this past week. He says that's about 2/3 of the pre-war flows. But importantly, John, the Energy Secretary went on to say that half of those supplies are moving through the Strait of Hormuz and the other half are going through bypass pipelines.
Tyler Kendall with the latest down in Washington. Tyler, thank you. So the broadening conflict across the Middle East pushing crude and refined product prices higher. The Shell CEO delivering a new warning on cost and supply.
As we err towards producing more jet fuel to meet that season of demand, it does mean that you are reducing gasoline and diesel production. And what we are finding at the moment is both gasoline and diesel are at decadal lows in terms of inventories, which starts to put pressure on those price lines.
Paul Sankey of Sankey Research writing, we have been super bullish on refining and think there is a major crisis here. We argue people are looking at the wrong oil price. Crude is not the issue. Gasoline, distillate and jet are. Paul joins us now for more. Paul, good morning. How small, how thin is the cushion? How bad are things?
Well, it's just that the refiners here, for example, refiners are running at 96% utilisation.
How unusual is that to run at 96%?
That's where we want them, and it's not unusual. I mean, for example, in Mexico, that would be 50%, you know, but it's an amazing performance, and it does raise the risk around refining because obviously when they're running that hard, hurricane season coming up, El Nino, we went through a couple of heat waves, and that causes issues. So I'm worried that there may be more problems. But the big idea is that basically wholesale gasoline is $140 a barrel. Brent is at 90, and that margin is absolutely massive in terms of profitability. As I say, it's a margin, not a price, the $70 refining margin. And that's telling you that the tightness is in the refining system. So there's plenty, more or less plenty of crude, a lot of it driven by China's behavior and by the SPR, which is another big turning point, by the way, because when we run out of SPR, which should happen around September, that'll massively change the dynamics of the WTI market here in the US, and it'll be very bullish.
When it comes to the products, which is most vulnerable right now?
Well, jet fuel sort of sits above distillate as the hardest to make, and the industry's done an amazing job of raising their yield and really addressing the jet fuel crisis. And the reason they do that, it's the highest margin product. So jet fuel has actually not been the problem that we anticipated, basically because we didn't realize the refining industry could generate so much more jet fuel than as they've been able to. The tightness at the moment, which is interesting, is the area that's normally not that tight, which is in gasoline, and that's where we're watching the inventories go way below the bottom of the range. And that's basically because they're pushing so much into jet and diesel that you're actually sucking down the biggest inventory, which is gasoline. And then, of course, as I said, you're drawing down the SPR very rapidly as well.
But on the SPR, Energy Secretary Chris Wright says it's a, quote, long way from operational minimum. You think there's an issue coming in September?
Well, that's depending on the rate that the weekly it's being pulled down. But the refiners now find it a great deal because they're basically taking physical barrels. They're not paying for them, and they owe physical barrels in the future. And as you know, pay back more barrels, but in the future, which is a much lower, something of a lower price. So the refiners want the crude. There's a big debate that hasn't really been addressed by the DOE of where the bottom of the SPR lies. They put out a note about Cushing, which is a different thing. Cushing is metal tanks above ground. The SPR is a salt cavern that you hollow out by dissolving the salt. Every time you take it down and then push it back up, you push water underneath and you dissolve more of the cavern. So there's actually a technical question. Is the cavern getting bigger? How low can it go? Is all basically not being addressed. Other than, you know, Chris Wright's, frankly, has a very high reputation in the oil industry. But as an energy secretary, he's said some things that haven't turned out to be entirely true, particularly regarding the Strait of Hormuz. So I'm not sure that, you know, what he says about the SPR is really definitive, frankly. We just don't know when we're going to have to stop downloading it, basically.
So the SPR is like a bag of popcorn where half of it's air, and you open it up and you don't realize until you finally get in there?
Oh, okay, yeah. I mean, it's going to get really convoluted here.
No, okay, hold on a second.
No, it's a salt cavern with oil in
it. In all seriousness, I am wondering how much credence you put to the barrels that are still going through the Strait of Hormuz and potentially through pipelines actually making it through, which has been a huge offset to some of the drawdowns that people were expecting.
Yeah, I mean, my latest research, which I haven't published it actually, but it's on the UAE, because the UAE is actually exporting more oil now than it was before the crisis started, and that's been one of the most stunning dramas here. And I'd add that, the front lines in this conflict are shifting. If you just look overnight, what you've seen here is US and Saudi basically fighting Iraq versus Saudi. UAE seems to be at peace now. They've made some kind of peace with the Iranians. There's no issues in Abu Dhabi at the moment. And of course, Israel, Lebanon is quiet. And then the other big front, which is going crazy, is Russia, Ukraine. That one is absolutely out of control. So the conflict has shifted quite dramatically, as any war would. And, I think the biggest one is that actually oil is coming out through the Hormuz. So, for example, UAE has been transshipping quite successfully. So what they're doing is using smaller, more discreet tankers, zip around the strait, and then load bigger tankers, to export actually more oil than they were before the crisis.
Do you think that we need to be paying more attention to what's happening with Russia and Ukraine, and that's going to take more barrels off than a lot of people are expecting?
Well, there's no question that this one of the stunning aspects of this whole World War III, because I always say if you're worried about World War III, you're in it, has been the emergence of Ukraine as a superpower, as a drone superpower. That you wouldn't have thought. Now that Ukraine is very popular in the Middle East, they're doing arms deals down in the Middle East. But what I will say is they're trashing Russia. And I don't know how much longer Russia can handle this. It's getting intolerable for the Russian people, I'm sure.
Paul, it's good to see you. Appreciate it. Thank you. Everything's personal with Bramo. You go to the movies recently? Did you get done over on a bag of popcorn? Is that what happened?
She went to see the Odyssey.
Oh, it was a bag of popcorn. No, it's just like a bag of popcorn or like a box of cereal when you open it up and it's like...
I would be scared of you at the movies right now. Like, you'd be throwing that bag of popcorn at me.
It's been a long week.
Right?
Tomatoes. Sleep is an important thing.
Kevin, avoid the movies, all right? Don't bump into Bramo. Not now. Paul, thank you, sir. It's good to see you.
Pleasure,
thank you
guys.
very much. Futures right now on the S&P positive by 0.6 on the S&P 500. In just a moment, we'll catch up with Nick Jones of BNP. He's cutting his price target on Meta. Many others have as well, on the back of some disappointing results. That stock is getting absolutely hammered. That stock is down by about 9% so far in the pre-market. The hits keep coming for the Fed chair. So dovish, it's hawkish. That just came from Bank of America. That ultimately it's going to make them need to hike rates to get back some credibility, and maybe as soon as September.
Yeah, I did get pushback saying that actually it's not that the Fed is losing credibility, it's that the market, to the point that Francis Donald was making, is waking up to the reality that inflation is going to be higher for longer, and rates should be too.
The reality is yields are higher again at the long end of the curve through 520. Up next, we'll get you some morning movers as well. ARM and Qualcomm sliding on a smartphone slowdown. The cash opened 2 hours away. Equity futures bouncing back. We're up by 0.6 on the S&P, higher by 1.3 on the Nasdaq. Thank you, Microsoft. That stock flying at the pre-market. We'll get to that story in just a moment. It's been a difficult moment, though. A difficult week for the Nasdaq. The Nasdaq 100 sliding for 6 consecutive days. Haven't seen a run like that since late 22, October to be precise of that year. And the semis have had a difficult run as well. We had a guest on the program talking about rewarding good news. The fact of the matter is, for the chip players, we haven't rewarded good news. We really haven't. And Samsung has been another example of that. Intel one more, SK Hynix another. We've seen it across the board, across that sector.
There's skepticism about the overall story, how long the hyperscalers can keep spending endless amounts of cash, given that this cash is increasingly coming from skeptical investors, and how long memory chip makers can continue with 80+% margins, because ultimately, when you have margins that, as Jason Thomas of Carlyle said, are too good, that invites competition. And that's what you're seeing coming from China.
Maybe the most bearish thing that came for the spending story yesterday came from the Fed news conference. The price of capital, the cost of borrowing is going up. Check it out. 30-year yields higher by 2 basis points this morning through 520, the highest since 2007. There is a lot of competition for capital out there, Bramo, and we're seeing some higher rates.
Yeah, a significantly higher proportion of investment-grade tech-related issuance so far this year has been 10 or longer, 10-plus years in duration. That really points to how the long end of the yield curve selling off affects these tech players. There is so much debt being sold that when you get yields at this level, you have to wonder if it starts to constrain the ambitions of some of these hyperscalers. And ultimately, we may see that over the next week.
Not yet. And that's what's interesting. They've not responded to it yet, but you do sense increasing indecisiveness over at Meta. Which direction is that company going to go in? The pressure keeps ramping up.
So Meta narrowed its full-year forecast for CapEx to actually the higher range, $130 to $145 billion. And they've gotten punished for their lack of decisiveness. Microsoft actually lowered theirs. And I understand it's a bit of an accounting issue, but at the same time, that's what's getting rewarded right now in markets.
Brent crude looks like this morning. Brent and WTI. Brent holding onto the 90s through much of this morning, just about right now. It's down by 0.75%. WTI as well, 83 on WTI crude, 83.60. It's difficult to say things are getting better in the Middle East. Probably easier to say things are getting worse.
They're getting worse. The president said he's going to hit them very hard. And to be honest, that's exactly what the United States did. Yesterday, CENTCOM came out with a statement talking about the facilities they are going after, trying to make sure they can degrade Iran's capability to stop vessels from going to the Strait of Hormuz. But now that is really just one choke point everyone's talking about. This conflict is expanding. It is going to Egypt. It is going to the Red Sea and the Bab el-Mandeb Strait. And as we just heard from Paul Sankey, a number of individuals, you have to also remember there is still a conflict going on in Russia and Ukraine continuously shows their ability to hit Russia deep in their territory, go after refineries, as well as their issues in the Black Sea and the Caspian Sea.
Oil still elevated so far this morning. As we count you down to the cash open, some 2 hours away, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing a big divergence in Microsoft and Meta shares this morning as investors reward the company where you can clearly see a return on all that AI spending, and that is Microsoft, where its cloud revenue growth rose at its fastest pace in 4 years, while at Meta, it painted a more muddied picture. A lot of analysts wanted to hear more about that cloud computing opportunity, but they did not get that from CEO Mark Zuckerberg. As you said, it just feels like there's a lot of indecisiveness there. Instead, Meta delivered softer than expected revenue guidance and a dramatic fall in free cash flow. Turning to the smartphone market, that is weaker. We are seeing ARM Holdings negative, but Qualcomm falling 5.4%. Both companies said that Qualcomm issued a disappointing forecast pointing to component shortages and higher cost issues we've heard about before, while ARM said that weakness in smartphones is starting to weaken its royalty growth. Both companies, however, are seeing strong demand when it comes to supplying data centers, but that is not yet big enough to offset the weakness that we're seeing in the smartphone market. And we end on a company that just reported earnings, and that is Norwegian. Shares falling 7.25% after it cut several of its annual forecast metrics. The company says that bookings for the next 12 months are lower than expected, pointing to softer demand, the conflict in the Middle East, plus its own company-specific challenges. But even if you admit it, you won't get a pass, John.
Yahira, I'm not trying to go. The stock is down by 7% at the pre-market.
Norwegian Cruise Lines has those like sort of fjord cruises that I think,
That's
smaller
like
ones.
Maybe the one exception.
Yeah, so I got you.
You're paying? Maybe the one exception.
Or the popcorn.
Just for the popcorn. Okay, not for the cruise. On our radar this morning, the US launching fresh strikes against Iran in response to attacks on American troops in Jordan. The conflict spreading across the region. Vessels in Egypt believed to be the subject of an attack for the first time. Elsewhere, it's the busiest day of earnings season, headlined by reports from Apple and Amazon. The tech giants set to offer the next test for the AI trade. Both mega-cap companies reporting after the closing bell. And finally, the president lumping in Fed Chair Kevin Warsh and a call for lower rates.
He's fantastic. He's a brilliant guy, smart. I know he'd love to see lower interest rates, but he's got a board, and it's a political board, and they want to keep rates up. But we fight through rates.
The timing of that statement was not very well timed. Let's put it that way. For the bond market sell-off that was materializing at the time, it came right at the end of that news conference with Kevin Warsh, and it made the optics, the backdrop, for his evasiveness in that news conference look a lot worse.
It just sort of underscored the dovishness of his lack of responses to a lot of questions in terms of Kevin Warsh in particular. Here's the issue. Was this at all coordinated, or is this just fueling conspiracy theories that's going to force the hand of Fed Chair Kevin Warsh to be more hawkish at the September meeting and push back against what we're seeing in markets?
The timing was unfortunate for Kevin Warsh because it just feels like a pile-on. He's getting pulled in one direction by the dissents and the hawks on the committee. At the same time, the president's saying he's fantastic, and the president is saying, and the president has sat down with him and interviewed him, I know he wants to see lower rates. I was expecting a phone call into the Fed show yesterday. I was watching, and all of a sudden,
you were ready to dial in.
All of a sudden, the president is starting to weigh in on everything. The one thing I would say, though, is that anytime you ask the president about rates for years, they should always be lower.
I'm pretty sure you've got my number. You could have dialed in at any point you wanted, OK? Are you buying that she actually wanted to dial in yesterday?
She definitely did not.
Of course not.
President Trump is a real estate guy. Real estate wants rates lower. I don't know that he's going to be happy with the long end yield going up to the degree that it is.
No way. This is going to create
problematic for the housing market.
Exactly.
Besson, over at the Treasury, very quiet. And we said yesterday on the programme, if he was looking at the response in this bond market, I'm not sure he'd be too pleased about this. And it's just going to put even more emphasis on them needing to issue at the front end of the curve. And then you start to think where this is going, which is why I keep going back to the yield curve story. And we could spend some more time on this later on in the programme. This move is consistent. I'm not saying it's because, but it's consistent with the idea that they put less emphasis on the policy rate and more emphasis on the balance sheet. You would see front-end yields come down and long-end yields go up. Whether that's going to happen, I don't know, but he gave a subtle hint to that in the news conference. And let's see if he gives that some more time later this year.
Yeah, can you peg rates at, say, 3.5% in the United States, issue all your debt at the front of the yield curve, have 3.5% of your overall base interest costs, term out any kind of long-term debt, and deal with the consequences that is likely to result from both the dollar, the long end of the yield curve, and potentially inflation?
Precisely. It's consistent with the move in the yield curve. It's consistent with the move in the US dollar. Let's see how this turns in the months to come. Let's turn back to the tech earnings story. Meta falling in the pre-market as investors digest a disappointing revenue guide. The company also boosting the low end of its capex forecast as it continues to ramp up AI spending plans. Nick Jones of BNP Paribas cutting his price target on Meta by $100 to $855, writing the lack of clear near-term returns on investments in combination with the potential need for incremental capital will likely weigh on Meta's multiple. Nick joins us now for more. Nick, welcome to the programme. We've seen the capital markets push back, the equity market push back on Mark Zuckerberg's plans before. And he is willing to make pivots, and we saw that with the year of efficiency in 2023. Nick, how close do you think we are to that moment for this company, for this stock?
After the earnings call last night, it doesn't seem like we're very close based on the tone of the CEO and CFO. I think right now, what investors are often missing with Meta's story here is they have one thing that a lot of the other AI competitors don't have, is they have profitable distribution through all of their applications. So these investments to them, I think, are critical. We've seen Sora launch and then, get shuttered. We saw OpenClaw. There's been new social media sites launch throughout this kind of AI trade over the last several years. I think for Meta, they see a real opportunity to drive investment here. So we don't think kind of EPS numbers are really going to move much on earnings. On the other hand, free cash flow estimates are likely going negative for the next couple of years, and they may need to raise some money to kind of fund from here. But overall, we actually think the strategy makes sense. We brought our price target down really to reflect sentiment. We still see pretty significant upside, but kind of as you alluded, the market really wants to start seeing some returns here.
So, Nick, as you know, it's an unforgiving backdrop right now. You said the strategy makes sense. Just makes me wonder why he's being so indecisive about what they'll do with their capacity, whether they'll sell it or use it internally. That indecisiveness, to some degree, is being punished this morning. I'm not saying it's the whole story, but it's part of it. What kind of decision ultimately do you think they'll make on that?
I think eventually they'll launch a cloud offering or some sort of neo cloud offering. The theme of the call last night was really balancing near-term opportunity versus long-term opportunity. And they kept, I think they said 2 or 3 or 4 times on the call that near-term compute is more valuable than long-term compute, meaning they might have some opportunistic deals to be made to monetize any excess compute they would have. But ultimately, the message remained the same. They intend to build compute that they want to use over time to improve the product on their platform.
What does Meta want to be when it grows up? I mean, we're talking about the metaverse. Now we're talking about cloud computing. We're talking about frontier models in addition to the core business of social media and advertising.
Yeah, I think AI is actually one of these new technologies that really enhance Meta's platform. So what do you really get from AI? You get much richer, deeper, and longer context windows. Who would benefit from deeper, richer, longer context windows? Well, that's advertisers. They have this huge huge user base that's engaging more and more with the platform, as reported last night. So this should allow them to serve the right ad to the right person at the right time. This should allow them to get deeper into social commerce, better content recommendations to keep folks on the platform longer and longer. So I actually think this technology may be somewhat different than kind of the metaverse initiative is better positioned to enhance the platform.
That's not sexy right now. And we heard that with Mark Zuckerberg. The idea of talking about catering to advertisers isn't sort of the hot thing, which is coming up with frontier models and being able to provide cloud computing and being able to change the world in all of these, high AGI types of scenarios. Do you think that Mark Zuckerberg will be happy with just being a really good advertising tool?
I don't think so. They also talk a lot about launching more enterprise solutions to enable workflows. I think increasingly they're going to enable SMB kind of agentic workflows, enterprise agentic workflows. A lot of the folks who use the platform for advertising, they have back-end CRM systems, they have internal workflows, they maybe need to process returns. There's a lot of things that could benefit from more technology through whether it's WhatsApp, Instagram, Facebook, on the platform that I think can broaden their revenue streams.
Nick, it's good to catch up. We appreciate it. Nick Jones there of BNP Paribas on this stock as they cut their price target and others do as well. That stock is down 25% from the highs of last year, from last August to be precise. It's down another 9 so far this morning. There is a profitable business in there. There's a big engine that churns out a lot of money, which is what Nick is getting at. At some point, it becomes a screaming buy. Right, at some point. And we saw that a few years ago. When they went into that year of efficiency, things started to change for that company, that stock, specifically really quickly. I don't know how close we are to that moment, but you need a heck of a lot more decisiveness than what we've seen in the past few days.
The last time free cash flow was lower than where it was in this past quarter was in that year of efficiencies in 2022. After that, free cash flow bounced back up. Yep. If, as Nick Jones predicts, you're going to get negative free cash flow for a couple of years, will this market tolerate the ambitions at the same time that they're coming at the expense of that cash-producing machine?
Certainly not tolerating it right now. The stock is down again in the pre-market by 9%. Let's give you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The Senate committee considering Todd Blanche for Attorney General abruptly called off its confirmation vote last night. 2 Republican senators are still holding out support. One holdout, Tom Tillis of North Carolina, wants Blanche to meet with Jeffrey Epstein's victims first. The Pentagon awarding major defense contracts to boost weapons stockpiles. Lockheed Martin winning a $59 billion deal to sharply expand Patriot missile production. General Dynamics and Huntington Ingalls securing contracts worth close to $76 billion for nuclear submarines and upgrading shipyard infrastructure. Jersey Mike's preparing for its trading debut. The company and some of its shareholders raising $1 billion in an IPO that priced at the midpoint of its marketed range. Shares pricing at $23 each and giving the company a market value of $7.3 billion based on the outstanding shares listed in the filings. That's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, questioning the North Star.
It was a real family fight. That's the better way to get policy right. That's our North Star. Market participants are learning to play the ball, not the referee.
Up next, we'll catch up with the former St. Louis Fed President, Jim Bullard, live from New York City. You're watching Bloomberg Surveillance. We're a long way from neutral. We're not here to close spreads. And then yesterday's performance in that news conference. He's not the first, he won't be the last. A new central banker struggling to communicate with a market that doesn't quite understand how to translate who this guy is, what he stands for, and what his preferences are. Right now, equity futures are bouncing back from losses yesterday, up by 0.6% on the S&P, on the Nasdaq 100 up by 1.4%. In the bond market, yields higher at the long end of the curve, 30s down, yields higher by a single basis point, 521. On 30s this morning.
Yeah, still at the highest levels going back to 2007. Real pushback. And ultimately, I think you're asking the right question. Is this by design, or is this going to be a closing the spreads type of moment as we get some of the rhetoric from other Fed officials? Is this the new policy of anchoring the front end of the yield curve and allowing the long end of the yield curve to do the dirty work? Or is this potentially something that is going to cause a reversal in policy?
I don't see him rushing to schedule an interview anytime soon. Let's put it that way. I do think that the others on the committee will come out swinging in the next couple of weeks. Only because of one thing in that news conference that stood out to me, and we talked about it briefly yesterday. I'm open to these ideas, a new way of communication. I think it will take time to internalize. Let's give it a chance. All of that stuff. But the tone was patronizing. When he started to talk about the big things, the big ideas they needed to discuss, as if we haven't discussed them or debated them for much of the last 5 years. If I was sitting on that committee, I would have been offended yesterday. And I've been looking for that in the tone, in the communication of these officials in the weeks to come.
People are smart, both on the committee and in markets. People are incredibly smart, sophisticated, and have been analyzing these questions for a long time. There's a family fight in markets about exactly how to interpret all of this. And I think it's wonderful to actually be open to that. But to talk around issues as though you're actually saying something is a triggering event.
Under surveillance this morning, it was triggering for Bramo. We're questioning the North Star.
It was a real family fight. That's the better way to get policy right. That's our North Star. If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. Market participants are learning to play the ball, not the referee.
So here's the latest. 30-year bond yields rising to the highest levels since 2007 as investors challenge the Fed's credibility, fearing Chair Kevin Warsh won't temper inflation fast enough. The former St. Louis Fed President Jim Bullard joins us now for more. Jim, for once, I imagine you were happy you weren't on the inside and you were sitting on the outside. What was your view of how that news conference went down yesterday?
Well, unfortunately, I thought it was a little bit rocky. It's probably not unanticipated, given that Chair Warsh is new in the role. This is his second press conference. But I thought, the sell-off for the higher yields in the 30-year are kind of nerve-wracking for a central banker. Dollar depreciation on the announcement. I think he needed to do more to create optionality in September, and he didn't do very much of that. He emphasized the inflation target and that you weren't backing off the inflation target, gave a little bit of a hint that, the measurement, might be a factor there. I don't think that was helpful. You might as well explain what the main arguments were around the table, because the members are going to go out and tell you what they are thinking, and basically what they're thinking is there are 2 more inflation reports to come, and we want to see those inflation reports before we get going on any kind of hiking campaign. So you might as well at least acknowledge, the contours of the argument. I understand he doesn't want to give forward guidance, but it's a work in progress, and he's very accomplished, I think, in many ways. But markets obviously didn't like this.
A work in progress implies there is some intent here. There is an objective. Jim, what do you think it is? What is the intent? What's the objective?
Well, I think he says what he means. I would characterize interest rate policy in the U.S. as being partly the Fed and partly the market. And he feels like it's become 90% Fed and 10% market. He wants that back to dial that back to 50% or something like that. And so that you can't drive either side to zero. Both sides have a role to play, but he feels like it's been too much Fed, not enough market, and maybe he's erring in the other direction now. But I think we'll get to a good equilibrium eventually.
Do you think, Jim, that there's a difference between forward guidance and a reaction function?
I do. I think, and we're struggling, I think, to know what he means when he says he doesn't want to give forward guidance. If you look at a Taylor rule or something like a Taylor rule, that tells you what the Fed would do in every single state of the world. And so that's forward guidance in some sense. But I think what he means is like the chair would come out at a press conference and say, hey, it's highly likely we're going to move in September, or it's highly unlikely we're going to move in September. That sort of forward guidance, I think, is what he wants to get away from. That might be warranted, especially when you want to have optionality to see how developments proceed.
The reason why I asked Jim is because he seemed to say that we're conflating the two and that people are asking for a reaction function when actually all they're looking for is some sort of forward guidance. And I just wonder what you make of the way he answered questions or didn't answer questions. I mean, did you think that this was deliberate, or do you think that there is a larger idea that the market isn't understanding?
Yeah, well, is it deliberate? Well, I'm sure he thought very carefully about how he wanted to handle things. And I guess one thing that stood out to me is that he didn't want to bring up, okay, there are 2 inflation reports before the next meeting, because I think he was feeling like that would create too much data dependence and too much focus on that. But that's really the story here is, can the committee count on inflation coming down, especially coming down, core PCE inflation coming down below 3% and being on track to go to 2%? Or are they going to have to get on a tightening campaign to make sure that that happens? So, the data is going to be important over the next couple of months.
Jim, do you think that performance makes it more likely they'll hike in September?
Well, he steadfastly stayed away from that. I think I would have preferred that he say, we're ready to move, under certain circumstances, and we're definitely willing to move. Instead, he only talked about the inflation target itself without saying that we're ready to take action. Markets didn't like that. And they actually, the 2-year yield went down. And so now markets are less sure that the committee will actually follow through and try to drive inflation back to 2%. So I think it is a bit of erosion of credibility. I think it can all be managed, but unfortunately, it was a little bit rocky.
Yeah, it wasn't a great performance, let's put it that way. Jim, thank you, buddy. As always, the former St. Louis Fed President Jim Bullard there on the performance of Kevin Warsh in that news conference just yesterday. Up next, we'll catch up with Matt Miskin of John Hancock, Walter Piecyk of Lightshed Partners, Mike Gapen of Morgan Stanley, Kelly Kowalski of Mass Mutual. The third hour of Bloomberg Surveillance is just around the corner.
Today, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate.
Those dissents were not done in a vacuum. Many people on the board are leaning towards a rate hike.
I'm particularly glad with the fact that they've listed the 3 dissenters.
Having dissents is not unusual. That being said, there's very little to hang your hat on in the market.
If the data ends up coming in line with his side, this may all work out, but if not, this could end pretty poorly.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
He's got good suits. He's got great suit game. No?
He does.
Everyone's being so mean.
He's got great hair.
He's got
great game.
The president's right. He has great hair.
He's got great hair.
He looks slick.
He has a great resume.
Looks the part.
He does.
Just doesn't say much.
Look, maybe he'll come out and he'll reverse course. And maybe he said everything he needs to say.
We're going to be nicer this hour.
I think so.
No, we're going to try. Just 60 minutes, Bramwell. You can do it.
I think
I reckon.
I will.
I reckon you can. Live from New York City this morning. Good morning to you all. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your price action looks like this. Equities bouncing back from yesterday's losses. A 6-day slide on the Nasdaq. We're higher this morning by 1.3%. Microsoft, a big part of that. The stock is up by 9% in the pre-market. Going into earnings a little bit later. In the bond market, 2s, 10s and 30s. We said yesterday on the Fed special, will this move stick? It sticks and some. Yields down 2 basis points at the front end, 425 on 2s, 30s up just a little bit. We're holding on to 520 on 30s this morning. Coming up a little bit later, look out for this, more earnings. on Wall Street, more Mag 7 names. You're going to hear from Apple, you will hear from Amazon. We see a big divide in the pre-market between the Metas and the Microsofts of this world. Where will Amazon and Apple fit in?
Yeah, Amazon's going to be more in line potentially with Microsoft and Alphabet in terms of direct comps. Apple, I actually think might be the most interesting one because it stands out as the anti-AI trade. They didn't do the huge capex that the other hyperscalers, the other tech companies did, and they're getting rewarded for that. And can they deliver some of the actual tangible consumer goods, especially with higher prices for the component parts?
Well, I think that's what's going to be interesting, too, where they see component prices going, and are they going to have to tap into potentially, at least in the Chinese market, maybe some other Asian markets, buying Chinese component parts because memory chips are just too expensive to keep prices down when it comes to things like iPhones and tablets.
Those two names in focus a little bit later on this afternoon. This tenor in focus right now, this maturity, it's the 30-year. The yield just about unchanged on the session, around 520. It's the highest level we've seen going back to 2007. And people in this bond market, by people I mean Lisa, fired up this morning on the performance of Kevin Warsh in that news conference. You're not alone. You've got a lot of company, I have to say.
Well, okay. First of all, I think that we're all very open to a new approach from the Fed and the idea of the sort of financial repression of the post-financial crisis not necessarily being the path forward. The issue for a lot of people is they don't have an understanding of what will force the Fed's hand to hike rates at a time where inflation has been above target for 5+ years. And that, I think, 5+ years. And that's the reason why you're seeing some pushback because it's not clear why they didn't hike. It's not clear why they would hike. And a lot of people are wondering whether this is just someone who's talking a big game and not going to actually act.
And John, you brought up a great point. What does the Treasury Secretary think of this and this performance? I went back to some remarks he said just after Kevin Warsh was sworn in. Quote, "We're going to get back to basics in terms of accountability and credibility." The market is not saying that that was basics of credibility and accountability. Also, I'm not saying whether it's the causation or the correlation, but rates peaked the day before Chair Warsh was sworn in. He cannot be too happy with this performance.
I agree with you, Annmarie, and it's working out what the strategy is. I think for many people on Wall Street, I'm thinking of Jim Caron of Morgan Stanley earlier this week talking about the strategy of Warsh, and it kind of made sense. It was fairly intuitive. You introduce some hawkishness to the front end of the yield curve. It helps you to cap rates at the longer end of the yield curve. You basically build up your inflation-fighting credibility credentials. That made sense to me. It's like we unwound that completely in just a full 180. In the bond market yesterday, we started to question the hawkishness at the front end of the curve and then started to question the inflation credibility at the long end of the curve. And now this can go somewhere else. And it's the next phase of the conversation I think is risky. I'm not saying we're going there, but I'm saying the moves today are consistent with it. And this is what I mean. If the market begins to believe we have a Fed chair that's not willing to fight inflation with rates but wants to do it with the balance sheet, and wants to accommodate more issuance at the front end of the curve coming from the Treasury, you'll see more of what we've seen in the last 24 hours. And what do I mean by that? You'll see yields come down at the front end, you'll see yields go up at the long end, and you'll see the dollar weaken. And that's entirely consistent with the price action of the last 24 hours. I'm not saying that's the reason for why we've seen that price action in the last 24 hours. I'm just saying there's a risk that the narrative starts to go to that place if they don't push back quickly enough.
Let the fireworks begin. We get Fed commentary, I'm sure, in speeches over the next couple of weeks. And then do we hear from Treasury Secretary Scott Bessent? Not only that, but we're also going to be hearing from Kevin Warsh, Jackson Hole. And right now it's a blank sheet. Maybe it's getting filled up this morning.
Coming up, we'll catch up with Matt Miskin of John Hancock with markets whipsawed by the Fed and mega cap tech. Walt Piecyk of Lightshed Partners looking ahead to results from Apple. Mike Gapen of Morgan Stanley breaking down the latest read on inflation and the labour market. We begin this hour with stocks bouncing back and bond yields at near 2-decade highs. Matt Miskin of John Hancock writing the bond market is flashing a bear steepening as the more tempered hawkishness did not appease the bond vigilantes. Matt joins us now for more. Matt, good morning. Good to see you.
Good morning. Thanks for having me.
Bonds on sale. Are you a buyer?
Yeah, we're starting to look at it. We're looking at 5% now on the aggregate bond index. We're looking at about 6% on corporates. High yield is back to 8%. If I can do 5 to 8%, look, yield is destiny at the end of the day. And there's a lot of volatility. There's a lot of uncertainty. I don't know where inflation's going. I don't know, especially after yesterday, I don't know what the Fed's going to do in September. But what I do know is if you can get 5 to 6% per year for the next 5 to 10 years,
you should take it.
It's not bad. And we've got what's called real yield, John. It's been a while. This real yield after the inflation deduction is actually pretty compelling. I'm not trying to say step into the 30-year. I get it. It almost looked like yesterday that they cut because of that steepening. Because I think what also happened was you had right before the meeting this, oh my God, they might actually surprise hike. So the 2-year yield rose and it flattened. And then that just kind of came off in the meeting. But look, yesterday, the 30-year going out like that, if it's your second day at the office, you come home and it's like, how was your day? Well, the 30-year blew out. Like, that would not be my best. That would not be how I'd want to come home. But I think that's how.
If you're interested in bonds here or close to getting interested to buy, what are you less interested in buying? What becomes a sell?
Well, here's the thing. If yields keep going, and this is the whole concept of let the bond market do monetary policy, is it's going to work until it doesn't. And I think in your first meet or your second meeting or how many weeks, he kept saying like, how many weeks exactly am I here? But, you can get away with that. At the next meeting, I don't think he can get away with that. If yields rise too much, it's going to break something. And, the liquidity is going to be pulled back. And companies need liquidity right now. You've got the AI theme that's just absorbing so much capital. You're going to hear more companies say, I need CapEx, I need issue equity, issue debt. And so if rates back up too much, and the consumer's okay, but it is not great. So if you're saying we're going to raise borrowing costs, we're going to let the bond market do the work for us, it's trial and error. And if it backs up too much, then all of a sudden something snaps. And then all of a sudden there's a liquidity event and yields tumble. So you want to make sure you're getting that. I think looking opportunistically in it. We've got a mild credit bias. We're not overweight, high yield. We've got a little bit. But just play it, I'd say middle of the curve or a little shorter than the middle of the curve, a little bit of credit, and just get paid income while you wait.
Does this introduce a lot more volatility and potentially spread widening to credit? Because right now, not only do you have questions about what higher yields will do to the overall economy, but also volatility just inherently in the Treasury is not a good thing for risk assets and spread.
I totally agree. I think that it can, yeah. I mean, and so you've got this uncertainty on top of uncertainty. And look, they're going to be looking at the economy. Spreads are 288 basis points as of today. They're off the lows. I mean, we're looking at oil prices. We still got, earnings season we got to get through. And we've got, more, we've got GDP. I think that's kind of lagged. But, I think the spreads are going to look at the economy more so than the Fed. But it does make longer duration credit that much more risky. I think the shorter end or even the intermediate, you're going to be okay. But that longer duration credit, yeah, that's a risky spot.
At what point will that constrain the spending ambitions of hyperscalers?
Right now, we are getting two massive forces colliding. So we've got these hyperscalers that are like, we need debt, we need equity, we need capital. And then you've got the Fed, well, before yesterday at least, saying we're tightening. And we've got the bond market tightening. So you've got these two forces colliding, and it's happening here at the end of the year. So I think that it can incrementally already weigh on something. You're seeing them report like last week, and the stock sells off. That is a warning signal to them saying, look, you don't have a blank checkbook anymore. That's getting taken away from you. You're going to eventually have to put your spending under control. And it's like these earnings reports, negative free cash flow, positive earnings. Like, earnings are opinion, cash flow is fact. And right now, the cash flow is negative.
So what do you do in this environment at the same time oil is going up because of a massive geopolitical problem that the diplomatic route doesn't seem to be the one that this administration is going to take?
It's going to be tough. And I don't think they should make policy decisions based on oil because you can easily make a policy mistake. 1 second you could feel like, all right, higher oil, inflation, and then the next day there's a headline and oil prices come down and then you feel like you're off sides. That being said, oil prices are higher. Supply has come offline significantly. I can't even believe where oil prices are given where we were, over the last year. We're up not that much. And we've had 20% of the global supply still basically constrained. We've released all this strategic petroleum reserve, and we're running we can't do that forever. And because there hasn't been any more meaningful, change to that narrative, I think that's going to keep elevated oil prices, and it's going to keep the Fed in a tough position to eventually probably have to do something. But again, I don't think they should move just on that. If the economy can hold up okay, that's probably when they actually go and...
The price of energy is going up, the cost of capital is too. The good news, look at these earnings from the likes of MasterCard. EPS coming in at $5, a little north than that, the estimate $4.77. The backdrop for the economy right now, this is the good news, that this economy is still okay. based on these numbers we see from the big companies in corporate America, they're still churning out fantastic earnings.
We've seen that from one consumer company after another. All the card companies have been beating expectations. MasterCard, just the latest. I mean, every single metric increased, including cross-border volumes and net revenue. This goes to the question of how long can you see a sell-off in hyperscalers before the wealth effect takes down some of this consumer spending? In other words, at what point does the weakness that we're seeing right now act as a leading indicator of what is to come, particularly at the high end of the income sphere?
That stock up by 3% so far in the pre-market. Matt, it's good to see you. Thank you, buddy. Matt Miskin of John Hancock there, weighing in on this Federal Reserve and what it means for this bond market. Close to buying. Close to buying. Not 30s, but interested in the rest of the curve.
There were two T-shirts I'd like to make. Yield is destiny. I thought that was fantastic.
You wrote down the quotes.
And the other one, earnings are opinion, cash flow is fact. I think that both of those could be really good mugs or T-shirts.
You wear that at the weekend. That would be very on-brand, Bramo.
I would. I actually think I should.
Yield is destiny.
I think that's fantastic.
OK, if you see Lisa walking through Central Park or something, yield is destiny. Let's give an update on news elsewhere this morning. Bloomberg Brief. Vonnie Quinn has that and more. Hey, Vonnie.
Hey, John. Thank you. The U.S. hitting dozens of targets in Iran in a 2-hour operation following through on President Trump's threat that they were going to, quote, get a beating. The conflict spreading across the Middle East with unclaimed attacks on vessels at an Egyptian port as well. Poland's Prime Minister Donald Tusk says an object that crashed near its border with Ukraine was a Russian missile. Poland says the incident took place at around 3:40 a.m. local time during an intense Russian attack targeting Ukraine. President Donald Trump praising Fed Chair Kevin Warsh, calling him brilliant after the central bank held rates steady for a 5th straight meeting. Trump saying, I know he'd love to see lower interest rates, but he's got a political board and they want to keep rates up. That's your Bloomberg Brief. John.
Bonnie, thank you. Thank you very much. Up next, the Morning Calls Plus. Walt Piecyk of Lightshed Partners saying Apple will have a hard time keeping up its recent growth. That conversation up next. Live from New York City this morning. Good morning.
Broadly speaking, there is absolutely increased attention on the ROI of all of these investments. This, very large increase in CapEx that we've seen across a number of key players in this space. And so, yes, there's increased scrutiny on the free cash flow that will be generated.
That was Gregg Moskowitz there of Mizuho weighing in on Microsoft. Microsoft putting up some decent numbers in the pre-market. The stock doing quite nicely. Equity futures on the S&P 500 shaping up as follows. Positive by 0.7. On the Nasdaq 100 up by 1.5. On the Russell this morning positive by 0.7. That's the bounce back in equities after yesterday's losses. In the bond market, just about holding on to that 520 level on 30s. Yields starting to come in just a little bit. The good news, I guess, this morning is that we're not continuing to see this bond market sell-off, because that would be pretty bad to see this 30-year become even more untethered than it was in the last 24 hours.
We saw a massive move yesterday. It's sticking, but at least it's not continuing to accelerate in this session. Real key question going forward, how much does some of the message from yesterday, or the lack of message, get walked back with a little bit more of a definitive guide into what they're going to do in September?
Let's talk about what's happening elsewhere. Let's talk about one name in particular, Meta. Here are your morning calls. First up, Citi, cutting its price target, citing elevated spending and lower free cash flow. Your second call from Piper Sandler, lowering its price target, noting lack of clarity in its near-term compute monetization plan. And finally, Wells Fargo slashing its price target, citing broad uncertainty on the hyperscaler investment cycle. That name is getting hammered. It's down by 10%. Let's stick with big tech. A fresh test ahead with results from Apple and Amazon due after the closing bell. Investors looking for the payoff from massive AI spending. Bloomberg's Ed Ludlow joins us now for more. Ed, good morning, buddy. And I guess that's what makes Apple different. They are different.
Yeah.
They're the standout in the Mag 7. They have not joined in the mega cap spending.
They're almost like
Yeah, they're almost like the AI safety trade, right? Because they're insulated from the capex story. They have very different problems of their own, largely centered in higher component costs, memory. But the market has really cheered them. Now they need to justify the premium. And of course, this is Tim Cook's final earnings call and release as CEO before he goes up to executive chair on September 1st and John Ternus takes over. But the street is expecting growth, 16% on the top line. A strong showing in services could be interesting. And then their full year capex, for what it's worth, just over $12 billion, which compare and contrast with Amazon is very much in line with the story of earnings season so far. We know how much Amazon's going to spend, $200 billion. And the thing is, it's highly analogous with Microsoft and Alphabet, Google Cloud, right? AWS, its core cloud unit, is expected to grow 31% year on year. That is real pace, bigger pace than they've seen in a long time. It's all the extra stuff, and that was kind of the lesson learned from Microsoft and from Meta last night. Other tangible data points that AI is getting traction for them. Key numbers, revenue, $197 billion. AWS will be $41 billion of that. But of course, it's the operating income cash cow. And so there is a high bar here. There is a burden of proof on Amazon, particularly to talk past capex if they give a number. Just a reflection that last night was quite tense because you waited on Microsoft and Meta to give that capex guide for the coming 12 months, and then nothing came. And so the market was like, OK, let's play with what we've got.
Ed, looking forward to the programme. Later on this morning, Bloomberg Tech a few hours away. Ed, thank you. Well, Piecyk of Lightshed Partners writing, it will be hard for Apple to replicate the growth the past year. Now investors are rewarding them for lack of capex and lack of AI. Walt joins us now for more. Well, welcome to the programme. It is strange that what was once a weakness is now considered a strength. Do you consider it a strength?
It's crazy. I mean, you can hear Ed talk about being the AI safety trade for a company that doesn't really have AI is kind of stunning. And I know there's been people talking that I have the developers mode software. I'm using the new Siri. It's better. Sure. It's not like great. It's still like not doing the stuff that they promised years ago. But right now we're in the middle of a good growth cycle. Remember, John, these cycles kind of come and go, right? The last time we had double-digit growth, particularly in iPhones, was 2021. And then prior to that, 2018, then 2015, then 2012. And all of those years in between, you had some cyclicality. Now, they can do stuff to try and juice that growth, price increases, $2,500 phones. I don't know if the operators are going to support that with the subsidies that are perhaps required to get the type of volumes that you need. So I think when you look at consensus, a lot of times, John, sell-side analysts basically, mark to market their stock prices because it goes up. The research director says you still have a buy, either move your price target up or downgrade. So they take the numbers up and take the numbers up. The reason the stock's going up, as you guys already mentioned, was probably more about this overall AI trade. So as a result, these forward numbers are starting to get a little ahead of themselves. Where I could be wrong. China's huge. They love the foldable phone. That grows and sustains growth for another year. But I think given where the valuation is on this, given where the trends have been in terms of money flows into it, because this quote unquote safety AI trade, it's just getting a little bit more risky to own here.
So with that in mind, what are you looking for later on this afternoon that might validate? What would be the metric that you would point to that you're expecting to validate the ultimate concerns you have?
I don't think there is anything because we're still in this upgrade cycle. There could be, if anything, maybe some, if people start anticipating the next phone, you see a rollover in growth. The operators have already reported, right? We know the upgrade rates have started to decline already. So there could be some flow through on this. So, but again, easy comps from last year, flow through of we're in this kind of cyclical trend right now. I'm not sure there's any real signal going into the September quarter, which only has a couple of weeks of new product launch sales. For them to change, I think, the already very bullish outlook in terms of growth. And remember, John, China also is like a big contributor to the growth the last couple of quarters.
Which also leads to a question of component prices and how much they're looking to potentially tap the Chinese memory chip companies for new parts. Do you expect any kind of announcement or tell on this call about that?
I mean, I'm sure they'll indicate that. Well, they've already increased price, right? They've shown that they quote necessary to increase these prices in order to maintain margin to generate tens of billions of dollars of free cash flow. So I think there'll probably be more support that, yes, the investors will see price increases to match the component increases. What we just don't know is how that may ultimately impact unit demand overall. I mean, people are able to and have shown that they can hold on to their iPhones for a very long period of time. These are very good products, and I don't think anything other than it being foldable, anything functionally new that would drive some out of cycle, super cycle that exists right now.
Do you think at the higher end and the more expensive phones, there is a greater emphasis being placed by consumers on AI capabilities, or a lesser one in terms of it being more of a vanity piece?
I don't think there's any focus on AI, and I think the reason is we haven't truly gotten to the power of agentic. Some of the stuff where your emails are summarized or how it helps your photos, obviously Android has those things sooner. It hasn't changed market share, quite the opposite. Apple continues to do well with market share. So I don't think we've gotten to the point where AI is delivering the functionality to your phone that is making the difference on why you would A, upgrade your existing iPhone to get whatever AI features that they're offering, or B, switch to Android, who may offer some of that. Now, again, we'll see. AI is changing very quickly, right? 6 months ago, like Apple was thought of like not the AI winner. Now they're quote unquote the AI winner. So we'll see what 6 months or 9 months looks like, if AI continues to advance in competing products.
Well, it's good to see you. Thanks for dropping by, as always. Walt Piecyk there of Lightshed Partners. To Walt's point, stock is up by something like 16% so far this month, just because they're not spending money. We're focused on what they're not doing. At some point, we have to focus on what they are doing, right?
Well, and they've actually been doing better because of some upgrades and because of certain cyclical reasons that Walt was laying out. How long that can continue, I keep going back to, what is it? Earnings are opinion and cash flow is fact, and that kind of is going to have to be what we see.
And yield is destiny.
Yield is destiny.
I like yield is destiny too.
I think that's fantastic.
You should make that t-shirt.
I really would enjoy that because it's true.
Okay.
It's like that is where we're going.
There's some branded merch here, don't we?
I think
make some mugs.
Yes, yield is destiny is a perfect surveillance.
Right, you want that?
Oh yeah, I think that's.
All
please,
right.
let's make
it
it happen.
Yours. All right, I'll make it happen for you. Apple down in the pre-market by 0.6. Annmarie doesn't want it.
Why?
No, you're not impressed.
I like my Yankees and Knicks mugs.
Okay, we're not going to take that away from you. All right, they're not playing well at the moment, are they?
The Mets are.
Just sort of bury that mug out of shame.
No.
Put it away. When does Boone go?
I'm a forever fan.
When does Boone,
that's a great
right?
question.
Yeah, there you go. From New York City this morning, good morning. You're watching Bloomberg TV. The opening bounce about 60 minutes away. Equity futures are positive by 0.6 on the S&P, bouncing back on the Nasdaq by 1.4, and the Russell higher by 0.55%, bouncing back from a pretty tremendous day of losses. Everything down really. 30-year got sold, equities got sold, tech got hammered, the dollar weakened. Wasn't a good picture for the Fed chair yesterday.
It was every single pillar of this market was getting kicked out from under it. On one hand, you had questions about the CapEx cycle and just how tolerant this market would be to financing the hopes and dreams of hyperscalers. You had a Fed that came out and was perceived as being more dovish, or at least not giving any kind of feasible explanation for anything. And suddenly you had a massive sell-off in the long end of the yield curve, and oil prices were rising in a reignition of what was happening in the Middle East. Essentially, everything was going wrong, and right now, hard to see what can rectify it.
Something going right. The data's pretty decent. Let's get into that data. Mike McKee has more. Good morning, Mike.
I hate to disagree with you this early in the morning, John, but the numbers aren't really all that good this morning. We haven't had a lot of numbers like this in a while. And they are backward looking because it's second quarter GDP. You got to go back to April, May, and June, comes in at 1.5%. That's after a 2.1% rise in the first quarter, and it's below the 2% that was anticipated. Now, personal consumption was higher for the quarter, 3.2%, than in the first quarter, 0.5%. But it started off strong in the first quarter and then was revised down. The latest numbers on income and spending, which go into this second quarter report, are from June. Income's up just 0.2 after 0.7 the prior month. Personal spending up 0.3. It was up 0.9 in the month of May. So when you average that out, it's still not a good number in terms of the consumer, and we'll have to see whether or not that continues to be revised. The PCE price index, everybody's been kind of waiting on that, although they can figure it out. Down 0.1%, as forecast. It was up 0.5% in the month of May. May. On a year-over-year basis, that leaves us at 3.7%. That's down from 4.1%. The core PCE number is at an increase of 0.1%, much lower than the 0.3 we had in May. And a year-over-year basis, we fall from 3.4 to 3.3%. And finally, jobless claims. Now, there's one that's good news, John. 197,000. That's up from a revised 188. Remember, last week was the lowest since 1969. So we don't have that historical comparison, but we do have a very low jobless claims rate. Continuing claims, 1,782,000, and that is down from 1,789,000. So all in all, the economy does appear to have slowed in the second quarter. The labor market seems okay, but you have to question, where is the consumer going at this point?
Mike, thank you. I was looking at the claims data. Mike, you know that. Mike McKee with the data. Thank you very much. 197, right? Continuing claims, not as bad as expected either. Labour market backdrop, still pretty decent.
Yeah, and this is the reason why you're seeing all of the consumer discretionary names do really well and perform with earnings that have continued to exceed expectations. There is this tension, between how long this is going to continue and whether wage gains are going to allow people to absorb some of the inflationary backdrop for the foreseeable future.
Mike Gapen fired up. You ready for this? Mike Gapen of Morgan Stanley joins us now for more. Mike, good morning. Good to see you.
Good morning.
Your thoughts, not on the data, on the news conference, the performance of the Federal Reserve in the last 24 hours.
Well, I would say if my conversations with clients are representative, I think investors largely found it disappointing, and I think they were confused, and I think some came away thinking that he was overconfident. So I do believe that there are mixed reviews on the performance overall. I think markets went into it thinking maybe there's a chance we're going to get a hawkish reaction function that would establish inflation-fighting credibility, and I think it walked out not quite sure what it had, and in lieu of that, and not knowing, priced in an outcome that suggests there's a higher bar to rate hike. So I don't know if I'd call it dovish. I think we thought we might get something going in. We didn't get that. I'm not sure we know what we have coming out.
I found it confusing.
Yeah.
I don't think I was alone. I'm open-minded enough to wonder whether there is a bigger picture here, trying to work out what that bigger picture is. What do you think the intention is here, the ultimate objective for this Fed chair? What's he guiding us towards? What's the process about?
Well, at least in the narrow sense of what should we expect from press conferences and communications, it's clear. He's not going to say a lot. And what I would suggest is that means there's a vacuum. So if the Fed is not communicating, it will leave a vacuum. And that hole is going to get filled by something else. It'll get filled by market views, our views, other sets of views. They may be right, they may be wrong, but what he's saying is that's fine, and don't look to me to course correct that. So I think he is intentionally trying to say less, and we'll see whether or not he can do that over time.
Do you think that this means he needs to do more? Do you think this increases the chance of a rate hike in September?
Not necessarily. I ultimately think it will be dependent on the data. There's also 18 other people on the committee who I think have kind of a more, say, conventional reaction function around this. So I do think the incoming data matters. We do think inflation will be behaving more in the second half of the year. So I'm not convinced they have to. But what I think markets wanted to hear were conditions under which they would. So the decision to not hike yesterday was not a surprise. But where I think the confusion is just essentially, well, why didn't you? And under what conditions might you? And so that's where, that doesn't mean he has to come back later and do it. I think the data will ultimately drive
Can I jump
that
in,
story.
Mike?
Yeah.
The confusion for me was when he was asked, why didn't they raise rates? Why did you keep rates unchanged? And he said, well, I don't think rates have remained unchanged. And then he pointed to what the market had done.
Right.
That's where it started to get confusing for me. Are you outsourcing monetary policy to financial markets? And then markets started to think, well, OK, they're not going to hike.
Right.
So I'm going to take all that back.
Yeah. Look, my biggest disagreement in all this is his analogy of we want the market to play the ball, not the referee. The Fed is not the referee in this. The referee sets the rules, enforces the rules, is an impartial arbiter, and the referee doesn't care who wins the game. Right? The Fed cares who wins the game. The Fed has goals and objectives in this. The Fed is a player on the field. The rest of the market cannot play the ball without knowing how the Fed might play the ball. So I think it's the wrong analogy. I don't think it's credible to say the market is telling us what it thinks about the data in the economy without thinking about how we think about the economy. So that's where I would strongly disagree on that stance.
To build on what John was saying, some of the interpretations from yesterday was that the Fed's lack of action in saying they're going to outsource it to the market was a Fed that didn't want to hike rates and was going to use any excuse not to hike rates just in order to appease potentially somebody in particular. I'm just wondering, do you think that the credibility of the Federal Reserve was deeply undermined yesterday?
I think Fed credibility took a hit yesterday. It doesn't mean it's not recoverable. I just think in the outcome of the meeting was we're not sure what you're doing. So yes, I thought you might be credible in this direction. I got a different message. I do think credibility suffered a bit. It's not permanent. But to your question on intent, again, if you don't fill a gap with your view, other views will go in it. Whether they're right or wrong, we'll ultimately see.
How do you think they recover? What does that look like? Do they need the data to come their way? Does that involve a series of speeches? Do they now need to hike even more in September? How do they recover from that?
Well, I think one is, yes, you get clarity from the data that make it clear what you're supposed to do. And in this case, it's either you stay where you are or you raise rates later this year. We think the data will conform. We think the Fed's on hold for the rest of the year. So the data would validate what yesterday was, let's call it a confusing signal of patience. He may ultimately be validated by the data. If the data is clear in the other direction, then I would expect a Fed that was unanimous in June, that was 9-3 in July, will move in the direction of hikes later this year.
How interest rate sensitive is this economy at this point? I'm talking about the long end of the yield curve. If yields remain at 5.21% on the 30-year, will that materially slow a U.S. economy that otherwise has momentum?
Yes, but I think why I'm hesitating is there's one side of the economy that's really not interest rate sensitive, and that's generally the AI story. The view is 50 basis points here or there. It's not a yield sensitive decision. But mortgage rates went up yesterday, right? So the non-AI part of the economy, which is already somewhat modest, you saw the GDP data, the consumer is a little bit modest, right? That depresses non-AI activity. So one of the challenges for the Fed is where the resilience is coming from and where some of the upside risk to inflation is coming from or downside risk to the labor market is not really interest rate sensitive right now. So yes, on net, but you're weighing on the parts of the economy that are already soft because you can't necessarily counter the other side of the policy with a 25 to 50 basis point change in front end rates.
So let's talk about the other tools. Can we finish on the balance sheet? He was asked the question about monetary policy, and he said if inflation continues to be elevated through the forecast period, interest rates could well be part of the solution. Could is balance sheet an option here?
Yes. So the forecast period in this case is the 3-year horizon of the projections, assuming that those are still valid. So yes, what I think he's saying is interest rates are not potentially the only part of the solution. So I do think he is trying to interject some potential role for the balance sheet. Whether the data in the economy allow that to materialize, we'll see. But yes, I do think he was not giving a nod to potential balance sheet actions.
How is that going to work? Do we have to wait for a task force to complete? How quickly do you think the rest of the committee could get on board with the idea that yes, inflation's above target, but no, that's not the right tool. We need to look beyond just interest rates.
Middle of 2027?
You'd have to wait that long.
Task force apparently won't complete its work until the end of this year. 3 to 6 months to debate the options. Unlikely that the economy will allow that to proceed.
Mike Gapen of Morgan Stanley. Mike, thank you.
Thank you.
Appreciate it. Very diplomatic. Appreciate some diplomacy this morning. Bramo's been so fired up for the last 3 hours. Well, just trying to rein Bramo in, just losing it.
Well, you know, I don't often have such a clear sense of exactly how things are shaking out, but particularly that press conference, when there are a lot of words and you're like, I'm not understanding this, putting them together. I understand English, but the words put together don't really make sense. It's a frustrating feeling.
I'm not so frustrated anymore. I've kind of chilled a little bit. I think the market has as well. I'm trying to work out a bunch of things, though, that I still don't really understand the answers to. I go back to initially we thought that the Fed chair was trying to introduce some hawkishness into the front end of the curve. kind of made sense. That's why two-year yields started to come up. And then when he started talking about outsourcing monetary policy to financial markets, the market just looked at the bond curve and just said, OK, we've been pushing on the wrong side of the curve here. Forget front-end rates. We'll tighten things up on the long end, especially when he's sort of open to using balance sheet and not so open to doing anything with actual interest rates. And that's where the debate's going to go from here through the summer. I also thought it was really weird the way he talked about Jackson Hole. Once he said, I'm only going to talk when I've got something to say, you can't say I've agreed to talk and the page is blank, right? That doesn't really add up either.
This is what I mean about saying a lot of words that don't really make sense. I mean, the whole idea that forward guidance and reaction function, he was saying, are two sides of the same thing, and that you guys are just essentially asking me for forward guidance. And people said, no, we're asking for the reaction function and exactly what's the model that you're using. The idea that you're talking about, that it's an input in terms of what the market does. OK, then does that mean you're market dependent? No, it's one input of all the input. So what are we talking about here? Which is the reason why the sort of cyclical experience was somewhat dizzying.
It was very circular, wasn't it? It was just round and round and round and round. We called it a three-part act yesterday, and I think it's important to keep going back to that. The statement's one, the news conference is the other. The third piece of this act is all the Fed speak you will get in the next few weeks, and I just think that's going to be so important. How offended were they? They're human beings. I thought some of that news conference was patronising. We've talked about that repeatedly in the last 24 hours. Does that change the tone they'd already got? I could sense some snark from some Fed speakers, I won't name them, going into the quiet period before this news conference even started. How much are we going to see of that in the next month?
Yeah, ultimately, that's going to set the tone. I mean, could you see a situation where Kevin Warsh is in the minority and the Fed votes to hike rates? Is that something that potentially is on the docket?
Something to watch for. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Recapping all the data we just got. Second quarter GDP coming in at 1.5%, missing estimates and lower than the 2.1% rise in the first quarter. Meanwhile, PCE falling 0.1% last month on the back of lower gasoline prices. Jobless claims also costing 197,000 initial claims filed last week, slightly lower than estimates calling for 200,000. Continuing claims coming in at 1.78 million, also below expectations. Jersey Mike's is preparing for its trading debut. The company and some of its shareholders raising $1 billion in an IPO that priced at the midpoint of its marketed range. Shares pricing at $23 a piece and giving the company a market value of $7.3 billion based on the outstanding shares listed in the filings. And that's your Bloomberg brief. John.
Vonnie, thank you. Thanks for this morning. Up next, we'll catch up with Kelly Kowalski of MassMutual, saying even a jumbo rate hike won't bring inflation down to the Fed's target. Plus, Yahira has your morning movers. Microsoft leading the rally this morning in tech. Meta disappointing. Amazon and Apple up next.
The Fed is not the referee in this. The referee sets the rules, enforces the rules, is an impartial arbiter, and the referee doesn't care who wins the game. The Fed cares who wins the game. The Fed has goals and objectives in this. The Fed is a player on the field. The rest of the market cannot play the ball without knowing how the Fed might play the ball.
Mike Gapen of Morgan Stanley weighing in on this Federal Reserve led by a new Fed chair, Kevin Warsh, in his second news conference that was a little bit rocky, according to the former St. Louis Fed President Jim Bullard and many others with much stronger words to describe the last 24 hours. Equity futures right now in the S&P 500 firmer by 0.6. The market doing better. The Nasdaq higher by 1.6%. The opening bell about 42 minutes away with some morning movers just ahead of your cash open. Yahira has more. Hey, Yahira.
Hi, John. The difference between Microsoft and Meta is clear as day, as you can see, as investors reward the company that's showing a clear return on investment from all of its AI spending. And that is, of course, Microsoft revenue in its cloud unit rose at its fastest pace in 4 years, while at Meta, it forecasts softer revenue growth and a dramatic decline in free cash flow. And I added Amazon to this board since, as you can see, shares are up 3% ahead of earnings later today, with investors hoping that Microsoft's strong cloud growth will translate into strength at AWS. We turn to MasterCard. Shares are up 3% in the pre-market after it gave us another strong read on the U.S. consumer. After Starbucks and Chipotle also helped to lift optimism, the payments company delivered an earnings beat driven by strong transactions volume. We've heard similar messages from Visa and MasterCard in the past 2 weeks. And we end on Crocs. Shares are plunging 12%, but the problem here is not the consumer not buying its products. It's high expectations because the company beat on earnings, sales expectations, and even raised its full-year guidance. But after shares rallied 56% this year, investors are focusing on some small blemishes, but it's just another example of this market leaving companies with little room for error. John?
Crocs and cruises. I just can't. Yahara, thank you.
Cruises and Coke.
I just can't.
Drink a Coke
I can't,
on a
I
cruise.
can't with Crocs.
With your Crocs.
Wearing Crocs. Is that what you need?
I think so.
That kind of
Crocs
break?
are awful.
That sounds
Please
like a
don't
nightmare
ever
to me.
wear Crocs, Lisa.
Sounds like an absolute nightmare.
I used to have Crocs.
I think you still do secretly.
You think that I'm a Crocs kind of gal?
I think so.
You know,
potentially.
Go ahead.
Potentially.
You have
There's
to be of a
nothing wrong
certain
with
age
it.
where they're only acceptable. Like my nephews like them, they call them fast shoes because they're in and out of the house, like they're playing in the
that's cute.
backyard. That's it. After 9 years old, no.
Right.
I'm still
There you go. Brownow's a child at heart. Nothing
We're
wrong
all
with
children
that.
at heart.
Aren't we just?
Yes.
Okay, let's talk about bonds, right?
Please.
Your 30-year bond yield hitting its highest level since 2007 as investors raise major questions over the Fed's ability to bring prices back under control. Kelly Kowalski of MassMutual writing a 25 or even 50 basis point hike won't single-handedly return inflation to 2%, but it could reinforce the Fed's credibility and help keep longer-term yields anchored. Kelly joins us now for more. Kelly, good morning.
Good morning.
Do you think they need to hike in September now?
I think this has become a lot more about credibility than actually bringing inflation down. If you look at what we saw going into the meeting, you had a decoupling in inflation expectations and oil prices. You had real rates rising. Why were real rates rising? They can rise for a number of reasons. Fiscal deterioration. Also, the market doesn't know the new rules of the game of this Fed, and I don't think we got that yesterday, which was part of the reason for the sell-off in the long end.
Do you think you can retain credibility just through speaking?
The market is telling us that's not going to happen. And it's interesting, right? Because during Warsh's first press conference, he said, we don't want the markets to listen to the Fed effectively. We want to listen to the markets. And it reminds me of the Spider-Man meme where it's like they're pointing at each other and it's kind of like who's directing who. And it feels like we're sort of in that paradigm right now.
At what point do you say that ultimately they've got to course correct? That ultimately the Fed has to come out and either hike rates or do some jawboning that's actually effective, that brings long-term rates in and gives you actually a buying opportunity? I mean, at what point as an investor do you look past this perhaps communication error?
Well, I think a lot of it does depend on the data we get between now and September, right? We've got a couple more inflation reports. We've got a couple more job reports. But I think if we continue to see this sell-off in the long end, we see the 10-year, for example, breach that uncomfortable point, approaching 4 3/4 to 5%. That's going to turn a lot of heads.
Do you think that at this point there is a threshold at which they have to hike or else the market is going to see that much more of a yield curve steepening and that much more of a dollar weakening?
It's hard to really draw, I think, a line in the sand. And look at the market this morning. I mean, even sort of with the pressure on, long-dated yields, the market's been anchoring to positive, results for Microsoft, and futures are up. So I think from where we are right now, there probably needs to be more pain. You probably need to see inflation expectations also creep up more, because that's one of their key arguments, right, is inflation expectations remain anchored. So I think you'd have to see that as well.
When it comes to earnings, we just heard from another guest who said, when it comes to earnings, you have the fact that when it comes to CapEx, that's potentially what you want to see in terms of, what was it, facts? Something is facts, yield is destiny.
Thanks.
We had Microsoft come out and Meta, very different stock story. What are you expecting for the remainder? We have Amazon today.
I think what the focus is going to be on the cloud revenue, the cloud backlog, and the CapEx forecast, right? I think, we were very excited to see Microsoft's results. They kept CapEx in check. The cloud backlog grew. And if you look at the backlog between Alphabet and Microsoft, it's over $1 trillion. So the demand is there for these companies. I think the market just needs to see that delicate balance between the demand, the CapEx, and the monetization. And what Microsoft did was they really struck it on the monetization, both with the Azure revenue as well as the Copilot adoption.
And the communication. I think communication has been such an issue, not just for these companies, but for central banks too. It's kind of defined the week, going back to Alphabet. For tech earnings, indecisiveness has hurt you. For central banks, indecisiveness has hurt you.
Especially when there's so much at stake. When inflation's been running hot, and when CapEx is running hot, and when cash flow is running low, suddenly communication and the direction of travel matters a whole lot.
Kelly, it's good to see you. All I can see now is that, Spider-Man meme. That's all I can see. Kelly Kowalski there of Mass Mutual on this Federal Reserve, looking at the market, looking at a Federal Reserve that's confused, very confused in the last 24 hours.
Yeah, the player ref experience
didn't work, right?
It just didn't work. And I think that is the key point that a lot of people are taking away. You can't observe bond markets in a vacuum. You can't observe markets in a vacuum. It's like the Heisenberg principle. I believe that's the one where it's like when you examine something, you're actually influencing the experience. And that's essentially what you're seeing right now. A lot of people said the market was responding to what Fed officials were saying. This isn't necessarily some sort of clear crystal ball.
You're a player.
Exactly.
Right, that was Gapen's point. You're a player on the field. Now, I get that he doesn't want to be and just trying to remove himself from it, but that's introducing some volatility to this market.
You're not a referee if you set interest rates. You are a player. So it doesn't make sense. And maybe it would have been better if he just didn't do the press conference in the end.
But he's going to be doing press conferences for the rest of this year. So
yay.
You wanted them. I was ready to get rid of them. You wanted them.
You're blaming
Extra
me.
innings.
You wanted them too.
I like watching.
You both wanted this.
Because I like watching them.
And you'll enjoy it. Every one of them. From New York City, thank you for choosing Bloomberg
Shut
TV.
it down.
This was Bloomberg Surveillance.